These are basically, they're in the hybrid category, but they are more debt oriented, I would say, or fixed income oriented. So someone who's a conservative investor who wants fixed income like returns, these are good funds to invest for that, for your debt needs as such. And we have our core equity fund, which is obviously the FlexiCap fund, and the ELSS fund, which is the tax saver fund. I'm not going to talk too much about the performance of the scheme. I think performance, for me, for all periods have been very satisfactory, and thank you to the fund management team for that. My family being investors, and most of our investments are in this scheme, I think we have nothing to complain about. We are pretty happy with the performance, and I hope other investors are happy also about the performance of the schemes. So this has always been, the cash holding has always been a feature of our FlexiCap scheme, so it's not something new that we've just done last year or something like that. It's, if you see the chart, it's always been there, it's been a feature. And a lot of people don't understand this, that cash is just not lying there and not giving you any return. This is just generating returns for us, 6.5%, 7.5% sometimes, so it's just not lying there. It's generating returns, So in a flat market like last year, it's actually helped out, So cash has been a feature, and also it doesn't even matter what AUM it is. When in 2018, we were just about 1,000 crore fund house, and we had our highest cash positions at that point at 28.4%. But and today also at 1 lakh crore, we have some cash positions. So the strategy remains the same. It doesn't change with the size of the scheme as such. And I'm sure Rajiv will touch upon some of those parts in his presentation. But also the fact that, sometimes there are no opportunities, or opportunities are hard to get by, or we like something and things are more expensive. So we don't mind. We're patient people. Like when I'm telling you law of the farm, be invested for 5 years plus and all. So we are also pretty patient about actually putting your money where we think it'll do you right, because the starting valuations matter a lot. The only way you make money is buying low and selling high. So sometimes you have to wait a little bit longer to get good prices. We are okay with it. And you see this, once we get some opportunities, we are also quick to deploy the money as such, So, so within 1.5 years from 28.4% cash, we were down to like 2%, So things can happen fast also, but opportunities need to be there. And when opportunities are there, we are happy to participate in that. And when we do this, when we have such a strategy which this is kind of the risk return profile you can expect. So this is a 10-year data of the FlexiCap, and this is through Morningstar, not our own data. So look at this, the risk versus the category. Our category is the FlexiCap category. It's low. And the return versus the category is high. So it's a low risk, high return kind of strategy that we try to do. And how do we do that? Is the upside, if you see the upside downside capture ratio, that means that over the last 10 years, when the index went up by 100, the FlexiCap category went up by 95, but we only went up by 82. So in a very, in a go-go bull market, we will be underperformers, we will most likely be underperformers. So keep that in mind. We've said this actually a lot of times that, this is a time we will probably underperform, and we are sometimes okay to underperform in extremely bullish markets, because things are anyway sometimes valuation-wise are more expensive. But look at the downside protection. I think this is where our strategy really plays out, and this says that if the index, which is the Nifty 500, goes down by 100, the category goes down by 93, we only go down by 47. And if we can do that consistently over the years, then this is kind of the risk return profile you can expect, So this is the strategy we've ran for like 20 years, and it's held us in good stride, first in the mutual fund, before that in the PMS. And I think this strategy really works for us, and we are comfortable with this strategy. So when and why do we launch schemes? So there are four main reasons why we will launch a scheme. One is if we can have any simplification or differentiation to the category or the scheme. Secondly, if it adds genuine value to our investors and meets their evolving needs. Third is we need to be excited to put ours or our family's money into such a scheme. And fourthly, if any regulatory changes are there and it compels us to launch new schemes, or the old scheme don't make that much sense, then that's the reason we will launch a new scheme. So again, a lot of questions also were asked, and in the last month, I've met people who said that, oh, are you all changing your strategy from one fund, and are you going to chasing AUM now that you're launching a new equity scheme and all that? So I'll just tell you why we launched, first of all, our history of why we've launched certain schemes and what is the future and what are we going to do in the future. So first of all, look, before we were a mutual fund, we were also distributors of third-party products, and there were AMCs who would come to our office and obviously, have that relationship. And again, one of the things we saw that there were too many schemes, and being in the industry, it was very hard for us to even choose schemes. I'm like, what's the differentiation between one scheme to the other scheme? The names are different, scheme names are different, underlying is almost the same. So our thought was, and this is in our initial time when we were making presentation, the first image would be of a Swiss Army knife, So our thought process was, can we have a fund like a Swiss Army knife, which is one device and multi-functionality, where you can invest across sectors, across geographies. The fund manager has all opportunity. Wherever the opportunity arises, the fund manager will invest in that. And that is kind of the diversified strategy that we really liked, and that's in the active space. That's the strategy that that's the only strategy that we run, and for the foreseeable future, I think that's the only strategy we will be running. So in a sense, there's no change in strategy in terms of the active equity space. Parag Parikh Liquid Fund was launched in 2018, 5 years after FlexiCap. And that was because it added genuine need to the client to do his SIP and STP. And the genuine need was that have a liquid fund to do SIP, STP. And we thought that, yeah, that will be an extension to the FlexiCap as such, will be enabler to the FlexiCap. Over the years, now we've also getting some good interest from corporates also to have to invest in our liquid fund. And Tejas is here, Tejas Soman. He's our new debt CIO. So we are also focused on the fixed income side going forward. So maybe over time you'll see a few more schemes from our side in the fixed income space. Again, TaxSaver it's a copy of the FlexiCap without the international investing, So again, there was no strategy change there, but from investors said that, listen, for my tax saving, why don't you start a TaxSaver fund? It'll help me, for tax saving. And we thought, yeah, that's a genuine need for our investors, and it doesn't require us to have change strategy or launch a scheme which we are not familiar with. In a sense, we don't like to slice and dice it into 10, 15 schemes. We want one scheme which can do everything, like I said, Swiss Army. So the TaxSaver was kind of a replica of the FlexiCap, so not much change there. Then in 2021, we launched a conservative hybrid fund, and this is basically having it has three asset classes: equity, fixed income, and REITs. And we thought this is interesting for people for their fixed income need, because people came to us saying that, yeah, we need some fixed income and we like you guys as a fund house, so do you have a product like that? And we said that this conservative hybrid fund, it's kind of like a very conservative multi-asset fund. It's got three asset classes, but we are running it more of from a fixed income or from a conservative point of view for your debt investment. So that helped us out with with at least starting some allocation from clients for their fixed income needs. Look, then afterwards, we have the arbitrage fund and the dynamic asset allocation. These two funds were launched because of the tax changes that went through, Arbitrage fund is good for people in the higher tax bracket to manage their liquidity needs than a liquid fund, because now it's taxed at your marginal rate. So that's how the arbitrage fund came. Also, we lost our tax advantage in the conservative hybrid fund. Now the conservative hybrid fund is taxed like a normal debt fund, which is at your marginal rate. And so we said that, okay, in the dynamic asset allocation, we can kind of replicate the same strategy of the hybrid fund, and we can launch it, and it's kind of similar, so dynamic and conservative. So that was kind of the reasoning why we launched these 6 schemes. Going forward, as most of you all would have heard, that we are launching a large cap fund too. And we've got a proper presentation of why we are launching the large cap fund, and my colleague Rukun will be presenting on that. A lot of questions about the large cap, that what's the strategy? Are you going to do it? It's obviously we've launched in the active space, but as you will see, we are launching it because we think we can make some differentiation into this category. Otherwise, you wouldn't have launched this large cap fund. And I will let Rukun talk about all the things that we are thinking about in this large cap. And we feel like no one is doing some of these things right now, and maybe we could make some sort of a mark, we hope, in this category. So we'll wait for Rukun to say his to have his presentation on the large cap space. I think it'll be very interesting for people. So again, a few things happening from an organization level also, you know. So we have received our board approval to incorporate a separate subsidiary and apply to PFRDA for a license for our NPS, or National Pension System, you know. So we've got the board approval. I think in a couple of weeks, me and Raju will probably go down to Delhi to meet the regulators, and hopefully there's no timeline as such on that, you know. Once we go there, only we will know more about it, and as there are any updates, we'll be sure to update everyone on this part. But yeah, we're very serious about this space, and we're doing everything to hopefully get it started sooner rather than later. We've also started our GIFT City operations, which is from the Gujarat city. And we are, 3 strategies kind of are there right now. The global PMS is live. They're tailored to, again, people, this is for the HNI category where the minimum is $75,000. And there's discretionary and advisory. So this is up and running already. So for resident individuals who are looking to do their LRS, this is an opportunity that's already live. We just received our approvals last week for our global international passive funds, which will be the S&P 500 and the NASDAQ 100. These will have a lower ticket size. It'll be a retail ticket at $10,000 would be the minimum investment, so it'll be accessible to a lot of people. Also, our inbound, we asked, inbound is basically people, foreigners, NRIs wanting to invest in India through the GIFT City route, which will feed into our FlexiCap fund. That we have filed with the regulator. We are waiting feedback, and hopefully in the next month or two, we should hopefully get that, and maybe middle of somewhere in 2026, we'll be able to probably launch that too. Also, we will have for the GIFT City being a separate entity, we will have a separate webinar for this, you know, because obviously there'll be a lot of questions around this in terms of operational, taxation, strategy, all those things. So I think we will take the GIFT City at a different forum with the people who are actually sitting in GIFT City and managing this for us. So we'll have a webinar for that once we start getting our approvals and when we are ready to launch, you know. So that's something, from my side. So thank you. Those were my opening remarks. I'll invite Rajiv to talk about the investment side. Thank you.
Good evening, and thank you for coming across and spending time with us. A lot of questions have come in which don't really matter. What matters is what is on the screen and what you learnt in high school. I don't know whether people remember this, but this is the compound interest formula that was there. Amount that you receive after a certain period of time depends on the principal amount that you have put in, which is P, which is multiplied by 1 plus the rate of return that you get on your investment, expressed in decimal form. And this is raised to the time or the number of periods, number of years that you remain invested. So much of question is there, what will be the return expectation, how much outperformance will be there, will you be barely meeting the index levels, or will you be underperforming, lot of other things. A big portion depends on you, not on me. Your 1,000 rupee monthly SIP is not going to make you Elon Musk or Mukesh Ambani. Sorry to be the bearer of bad news. Your P will have to be substantially higher if you want to reach there. So that is not in my control, that is in your control. How soon you start, how long do you remain invested, again is not in my control. That is again completely in your control, or maybe partly in your control. Life happens. Sometimes you may have a long-term plan and exigency may require you to redeem your investment sooner. But again, this is external to what our investment team can do, or what an investment team in any fund house can do. So we come to R. It may seem that R is under the control of the people sitting here, but even there we have only a partial control. Why partial? We don't decide whether you put money in your bank FD or whether you put in equities. We don't decide whether you buy gold or whether you buy real estate. We don't decide whether you buy in small cap or buy in the latest thematic fund, or you buy a diversified fund. All those decisions are taken by you or your advisor or your distributor. After you allocate in a particular scheme, we have some semblance of a control, but again, not entirely. If the market is down 40%, don't expect us to double your money in that year. We will probably, if we are disciplined and lucky and follow a process, we will do something better than the index. That's what we aspire to do. So actually a lot of things that you read or hear about in social media, or the clickbaity articles that you come across, is mainly noise. End of the day, it's this simple formula. Another piece of bad news that I have to share with you. Over allocating to equities does not automatically mean that you will earn a high return. There is this perception that if I have 6 months money, instead of putting in a bank FD, I can buy a mutual fund scheme, or I can subscribe to the latest IPO, which quote unquote has a good grey market premium, where under a lottery system I'll be allocated units, allocated shares in the IPO, and immediately on listing I can sell for a profit. This slide that you see on the screen is not just some data point, it's a lived experience. So I joined the workforce in the financial sector in the year 1994. I joined somewhere around April or May of 1994. That period was very, very similar to what we see today. We had absolutely no time. From morning till evening, we would pore over documents, do due diligence, prepare the prospectuses, file it with the regulator, get approvals, market the IPOs. This went on for about a year, 1994 to 1995. And then things changed very, very dramatically. From morning till evening, we were busy playing computer games because the IPO market went dead. Not a single IPO, not just for our company, but across the market would come to the market, and there was zero appetite. So there are lessons over here. Equity can potentially give you higher returns, but only if your investment period is sufficiently long enough. And not all goals are decadal or multi-decadal in nature. If a 25-year-old is saving for retirement, by all means, invest in equities. There's a very high chance you will do well over the next 20, 30 years as India grows, as India prospers, as our corporate sector delivers higher profits in the future. But if you have money, if you have an asset purchase coming up, if you have a family function coming up, if you have a child's education lined up in next 1 year, 2 year, 3 years, don't risk your money. It's not a guarantee that if you put in equity, you will get substantially higher returns. Many a times these side periods last for 5 years, 10 years, 11 years. And it's not just in India, it happens globally. People, when they plug in numbers in their financial plans, typically think that whatever is your equity allocation, that should generate something like 15% return for you. Recently, there was a podcast where I was interviewed, and it was a multi-hour conversation. Of that, one snippet was picked up and was converted to a headline. That headline was expect something like 10-12% kind of returns. And people took great offense at this statement, saying, how can this guy say this? Why are we paying him his fund management fee if he's just going to generate 10% returns or 12% returns? Pop quiz. What was the index return over the last 12 months? It's most likely single digits. I haven't checked as of yesterday, but last 1 year hasn't been great. So these kind of things happen. And when we look at these 15% kind of index returns, we have to remember that this includes a period of 1990s where government bonds were paying you 14% return per year, where AAA corporate bonds were giving you 18% return per annum, and AAA NBFCs were paying you 21% per annum. PPF rate was 12% per annum. So that was a period of high inflation, high interest rates. So nominal returns were definitely higher. Today, we are seeing much lower inflation rates and consequently much lower nominal growth rates. Nothing wrong, it's a good thing that our purchasing power is not eroding. But the XIRRs that you will see in the statements or the return numbers that you see could be subdued given the lower nominal growth that we see. So it's not something that you should be surprised by, and you should definitely look at estimates which are more realistic and not just colored by your past 3 years or 5 years experience. Longer term returns tend to be somewhat lower and more in line with the nominal GDP growth rate rather than some random number that people expect. Neil mentioned some of the activities that we are trying in Gift City. From the mutual fund perspective, no change in RBI limits, no update to give there. We don't determine policy. We are given a policy under which we have to work. So the mutual fund schemes cannot remit money outside to invest globally. LRS remits remain open. So global diversification, we have been advocates of that since 2013 when we launched the mutual fund scheme. But incrementally, that is not possible under the mutual fund umbrella, not only for us, for the rest of the players in the mutual fund space. A common question which kept coming in the form that was put out, can the mutual fund scheme invest in the Gift City fund? Answer is clearly no. Gift City funds will accept money in dollars. And given that the fund house has hit its dollar remittance limit, we cannot invest either in Gift City funds or direct stocks abroad. So no change as far as the mutual fund scheme goes. Doesn't mean global diversification is not important. It is, but that will have to be done at the end investor level, not at the mutual fund house level. That brings me to the outlook. There is this fictional story that goes around. It's not based in scientific fact, but still take it for what it is. So the story goes like this. If you take a frog and throw it in boiling water, the frog will immediately jump out because the water is hot. But if you put the same frog in a lukewarm water and you gradually put the water on a stove and you gradually keep heating it up, the frog does not notice the heat and then remains in the water and dies. not accurate, but assume it is true. This is what has happened to the investors at large. Last 22 years, from 2003 to 2025, we have had the earnings multiple or whatever, DCF multiples, whatever is your favorite metric. Stocks have gotten more expensive as compared to the assets that they own or as compared to the earnings or the cash flows that they earn. This has happened slowly, 2 steps forward, 1 step backward. There have been steep corrections in between. 2008, there was a big crash. COVID, there was a big crash. But over a period of time, multiples have crept up. They've crept up so much that in a way, in a lot of cases, it's now like the boiling water. And collectively, all of us frogs are still in that water, and we haven't noticed that the multiple creep has happened. 2003, you would have stocks with a reasonable quality trading at earnings multiple of 5 times, 10 times, and 20 times. Things like HDFC Limited, Asian Paints, Pidilite Industries, Marico, all these were available in these ranges. In a lot of cases, you would have dividend yields of 10% and 11%. So from that time to today, almost every stock has a 50 times, 60 times earnings multiple, 65 times earnings multiple. A lot of them are in triple digit price earning multiples, showing earnings growth of 5% per year. Or a lot of companies actually have not earned any profits, but still the narratives around those companies are so strong that these are the future dominant companies of the economy, and people are willing to pay any price for those. So when I sound cautious in my remarks, or when I say that investors should tone down their expectations, it's driven by the starting valuations. Ultimately, if you pay a very expensive price for at your entry level, your future returns will suffer. A few years back, there was this theory which went around saying for quality companies, starting valuations don't matter. That turned out not to be such a great idea. Starting valuations do matter. So even for well-run companies, even for great companies, be cautious in terms of what price you are willing to pay. On the first date, everyone is well behaved, right? You will not find out flaws of other individuals when you meet them for the first time and when you go out for a coffee. It's only after you have spoken to that person's friends, met their family, looked at their past history, known them for a while, that you can arrive at a judgment as to how this person really is. Same applies for newer companies getting listed on the exchange. An entire ecosystem of corporate communications people, advertising agencies, investment bankers, the promoters themselves, they are incentivized to put their best foot forward to show everything that is great with them and get listed. It's only after a few years have gone by that you realize what are the salaries they are paying themselves, are they doing related party transactions or not, do they have proper capital allocation policies or not, were the reported sales and earnings numbers just prior to IPO, were they juiced up or were they the regular numbers? So all this is known only after a certain time has elapsed. So in the past, we have seen record number of IPOs coming from India, and that trend continues. Only caution I have for the investors is take your time. Don't rush into everything that is coming for listing. It is popularly said in the markets that in the markets either you have bold investors who are very enterprising, aggressive and all, or you have old investors. You very rarely have old investors who are also bold investors. So I definitely am in the category of old investors, having seen some of these cycles which have gone up and down, and some of the caution that you see in my statements or even in the behavior of the scheme and the fund house would be reflective of that. Be cautious. So much chatter has gone around because these are this is a large scheme. It's only because of that they are holding so much cash. We have held, Neil had that chart, so I had not seen the slide deck before I put this, but we have had large amount of cash even when we were a sub 1,000 crore fund house. So this is nothing new for us. All that you require is place buy orders if you want to deploy cash. That's very, very easy to do. It's just that we are not comfortable with the options that we have for buying. All the AUM related questions, people have this special love and affection for our fund house. They keep asking us this each year. I'm not joking. The first time this question was asked to me was when we were around 700 crore AUM. That time the question was, will you stop taking fresh money when the fund reaches 2,400 crores AUM? Because at that time we were having 30% allocation to foreign stocks, and the RBI limit was or SEBI limit was very, very small for foreign investment. So we have been having this question since, I think, 2014 or 15 or thereabouts. There are plenty of people who are 4 times, 5 times our size. Today there would be about 50 players in the asset management space. Our market share in equities would be around 2.5%, roughly thereabouts. If 50 players are there, on an average, you would anyway expect a 2% kind of market share. So it's neither here nor there. Obviously, we are not a tiny fund house anymore, but it's not something which is exceptionally high if you look at the overall size of the fund industry. This is slightly old data. This is taken from the Amphi website, where they categorize stocks into small, mid, large caps. So large cap is the top 100 companies. Here at number 100, Jindal Steel and Power at the end of June 2025 had a market cap of 91,000 crores. Now this number, just yesterday I was checking Screener, this number has gone to 1,07,000 crores. The company listed at number 100 is already at 1,07,000 crores. If you look at the last few months, July onwards, you have seen companies like LG India getting listed. You have seen companies like Tata Capital getting listed. You have seen Grow crossing 1 lakh crore market cap. So a lot of 1 lakh crore companies are coming to the marketplace. So obviously 1 lakh crores, no one will argue that the fund is too large to invest in such companies. So large cap is taken care of. People will say, but what about mid caps? At number 250, June end, the size of the company was 30,750 crores. That number is already at 34,000 crores today. Small cap companies are also not that small. So the smallest in 500 companies was at 10,000 odd crores. That number is now 14,000 crores. If you look at the announcements which are there, so ICICI Prudential AMC is going to get listed. That is a 1 lakh crore kind of market cap company. SBI Mutual Fund has announced its IPO plans. That will surely be a 1 lakh crore kind of company. National Stock Exchange is going to get listed. Jio Telecom is going to get listed. So this is just a partial list. So many companies are going to come and get listed. So don't just look at the size of our AUM, look at the size of the market. That itself is growing very, very rapidly. So the cash that you see is a function of the opportunity set and not of anything else in that sense. A lot of people say, what are you guys doing? So many mega trends are playing out in the market space. Haven't you heard about Make in India? Haven't you heard about indigenization of defense? Haven't you heard about energy transition and renewable energy? Haven't you heard about electrification of vehicles and the EV ecosystem? Haven't you heard about artificial intelligence? So what are you guys doing when so many themes are running parallelly? Why are you guys sitting on so much money? So themes are very, very obvious to anyone and everyone. You just have to open the newspapers or watch TV news and you figure out what are the themes that are running. The difficulty comes in actual execution and actually making money out of those investments. So the poster boy of organized retailing in India, the previous version, had to go through a lot of restructuring and a lot of the valuable assets had to be sold away because the balance sheet strength was not there and they got into too many different activities. Renewable energy as a theme has been around for more than 20 years now. So a windmill company got into trouble some time back despite the theme being strong. Mid-90s, private sector airlines, mobile telephone companies, all of these got into trouble. So just identifying a theme will not make you easy money. You have to ensure that a lot of other things are also there with that, and we will undertake proper diligence when we do our investing. You will see a little bit of buying, selling in some of these stocks, and a lot of chatter comes around there. So one of the things we have spoken about in the past is that as a scheme, we can do covered call option writing. So let us say we have 100 shares in our demat account. We can sell call options at a price which is much higher than the current market price, and we can earn premium out of those options. Now there is no risk as such. If the price shoots up, we can simply give delivery of a small quantity from the shares that we already own. As you notice, last 1 year it has been a very, very flattish kind of market. It's been a fully valued kind of market. So we have been writing covered call in a lot of companies. In most companies or in most call option writing, we get to keep the premium for free. Once in a while, some of these calls get exercised and we give delivery at that higher price that is there, and we effectively sell those shares. It also gives us an opportunity to buy back those shares in the next month or in the month after that when the price falls. So a little bit of at the margin, some small quantity gets bought and sold, and social media being what it is, it gets blown out of proportion. These are hardly 0.5% of our position which gets bought or sold, but people say, what are these guys doing? 1 month they bought, 1 month they sold. So don't pay too much attention to this. It's something which is being done at the margin, and broadly it's benefiting the unit holders. We are mindful of how much total earnings come out of it and how much of share sales happen because of this. Thank you so much. Thank you so much for all your love and affection over the years. And a lot of people ask us, when you started off, did you think about the size that you would reach, and did you imagine that you would be at this place? Not in our wildest dreams. So apart from the monetary value or the size of assets, just the sheer number of clients that are there. So around 53 lakh plus clients across the country. So thank you for all your love and affection over the years. Thank you. Over to Rukun for the large cap presentation.
Good evening, everyone. Thank you very much for coming here, taking time out to attend this forum. a lot of discussion and debate has happened on social media as to why we are launching the large cap fund. Hopefully with this presentation, we'll be able to address all those questions. So as Neil mentioned, one of the things that we've maintained is that we'll launch a fund when there is a genuine investor need that we can meet and wherein we can bring in some differentiation. The large cap fund is a step in that direction. If we look at the investor need, there is a certain segment of the market which needs broad diversification. They want exposure to a broad section of the market. They want low active share. They do not want the fund to be very different from the index and take the risk that it significantly underperforms the index. So they want low active share. Since they do not want the fund to be very different from the index, they also don't want a very high expense ratio. They want a low expense ratio. Now, if you look at the market offerings today, passive funds address this segment of investors. The Parag Parikh Large Cap Fund will address these needs, but because it's an active fund, we believe we'll also be able to implement some strategies, which we call smart execution strategies, that will help us differentiate and add value to this segment of the market. So how will the portfolio be constructed? The fund will endeavor to have exposure to all the Nifty 100 stocks, which is the top 100 stocks by market capitalization. And there will be an endeavor to have this exposure in weightages that are similar to Nifty 100, which is based on free float market capitalization. The weight of any stock will be capped at 10%. Sorry. So how do we differentiate ourselves? We differentiate ourselves in how we get this exposure, in how we implement these trades and how we execute them, as I call the smart execution strategies. I'll elaborate on these in the coming slides. Now, one of the questions that might arise is, why are we focusing on Nifty 100 and not Sensex or Nifty 50, which are more well-known indices? So Nifty 100 gives you a much broader exposure. If you consider the top 500 stocks as your addressable market, then Nifty 100 almost covers 70% of the market cap and profit pool, versus let's say Sensex and Nifty at about 40-45% respectively, approximately. So you're getting a much broader exposure through Nifty 100. I'll cover these smart execution strategies that I've been talking of one by one. So one of the things that we can do is, whenever a stock is trading at a discount in the futures market, rather than buying that stock in the cash market, we can buy that same stock in the futures market, in effect giving us a lower execution price. Just as an example and for an illustrative purpose, on 30th September 2025, United Spirits in the cash market was 1312 rupees, in the futures market was 1305 rupees. You can get the same exposure cheaper by executing the same in the futures market. The second thing that we can do is that, just like in case of stock futures, there are index futures. And during times of extreme market panics, the index futures can be at big discounts. During COVID time, on a lot of days, the index futures were at like 50 to 80 bips discount to the index. In these kind of scenarios, rather than buying the underlying index stocks, we can get that same exposure by buying the index futures. The third thing that we can do is be more efficient in execution around merger events. Whenever there is a merger, let's say stock A is merging with stock B, there will be a swap ratio, and based on that swap ratio, it will be cheaper to buy either stock A or stock B. Just as an illustration, HDFC Limited merged with HDFC Bank. Now, we had the swap ratio, which is that 25 shares of HDFC Limited, if you had, you would get 42 shares of HDFC Bank. On any given day, one could have done the math and seen which of the two was cheaper. On many days or on most days, it was cheaper to buy HDFC Limited and ultimately end up getting HDFC Bank exposure. On most days, or in many days, this discount was almost 3.5%. So you could have gotten the same exposure, but at a cheaper price. The fourth thing that we can do is, we can be smarter around the rebalancing of the indices. Now, index committees announce the rebalancings in advance. So this is just a press release from NSE, wherein on 15th September, they put out this press release, and they said that on 30th September, these are the stocks that will be added to the index, and these are the stocks that will be removed from the index. There is a lot of money in index funds. Index funds only transact on the rebalancing date, which in this case is 30th September. Consequently, a lot of inflow and outflow from these stocks would happen on 30th September. But most of the market, or a lot of the market, knows this well in advance, and they will position themselves well in advance. Consequently, what happens is, a lot of arbitrageurs or traders will try to exploit this. Just as an illustrative purpose, this is an example of Trent getting added to the Nifty index. And you saw that 1.5 to 2 months before that actual rebalancing date, the stock price kept on going up because everybody realized that this is getting added to the index. A lot of index funds are going to come in and buy this stock on the rebalancing date. And once the rebalancing date passed, the stock again came back. As an active fund, we need not transact only on the rebalancing date. We can transact in the stock, or we can buy the stock gradually over a period of time and get a better price. The fifth thing that we can do is have a low active share to be used opportunistically in case of special situations like demergers. In case of a demerger, what happens is, let's say an index stock has demerged and there is one another company or a resulting company that has come out of it. In many cases, one of the two companies becomes very small and gets removed from the index. Again, just like in index rebalancing, when this company is removed from the index, there is a lot of selling pressure. Again, just for an illustrative purpose, ITC Limited went through a demerger, and ITC Hotels was one of the resulting companies that came out of it. The stock was removed from both Sensex and Nifty, and consequently, all the passive funds that were tracking either Sensex or Nifty sold these on the respective rebalancing dates. What you saw was that on these dates, there was significant selling pressure around it. Over time, that selling pressure went away and the stock rebounded. Again, as an active fund, we can, even if we have to sell the stock, we can do that gradually over a period of time. Coming to the expense ratio part of things, if we see the Nifty 100 index funds, the expense ratios range from anywhere from 10 bips to 30 bips. We will endeavor to price the fund within this range. There are quite a few expenses that, as the AUM scales, as a percentage of the AUM, these expenses come down. Hence, as the AUM scales, the expense ratio, the endeavor will be to move the expense ratio towards the lower end of this range. Just a few points on the scheme detail. There's no lock-in envisaged, there's no exit load, no entry load. We'll have a direct plan and a regular plan, and we'll have both growth and IDCW plans. So who is this fund ideally meant for? investors who want a broad exposure towards the large cap segment, investors who would prefer lower costs, investors who would prefer lower active shares, they would want a strategy that gives index-like returns, returns that do not deviate very meaningfully from the index, and investors who are geared towards equity and have a long-term time horizon of 5+ years. Who is this fund not suitable for? So if an investor wants a significantly high active share, if an investor wants the fund to significantly outperform the index, then this fund is not for them. An investor who wants very high concentrated bets on a particular stock, sector or so on, this fund is not for them. And for anybody who does not want to take equity risk and does not have a 5-year kind of a time horizon, this fund is not for them. From an asset allocation perspective, the aim would be to be largely invested in equities. The aim would be to have more than 95% allocation to equities. Again, depending on large inflows and outflows, this might vary a bit, but the general endeavor would be to be largely invested in the equity portfolio. There will not be an effort to keep changing the equity allocation based on market valuations or things like that. I'll just read up the disclaimer. The information provided is for illustrative and informational purposes, does not constitute an offer, invitation or recommendation to invest in the proposed scheme. The expected month of NFO may change. Past performance, examples, strategy descriptions do not indicate future performance or returns. The fund's investment objectives, strategy and risk profile are as described in the offer documents, which should be read carefully before investing. The views expressed are based on the current strategy of the fund management team and may change in the future, but shall remain aligned as per the SEBI regulations and offer documents. All information has been obtained from sources believed to be reliable, but no guarantee, warranty or representation is made regarding its accuracy, completeness or adequacy. Thank you. We aim to have the NFO somewhere in January of 2026.
Sorry, I just need to make one correction in my presentation that the outbound passive funds that we're going to launch, the minimum ticket size is 5,000. I said 10,000, but it's 5,000, so it's much lower. Thanks.
All right. Rukun, you read that very slowly. Normally in advertisements, they read it like at 3 times the speed. So welcome everyone to this wonderful community actually, because every year we meet almost as a community. So just a quick show of hands, how many of you have been our investors over the past year in any one of the PPFA schemes? No, just the past year, not before that, just the past year. Just the past year. All right, past 5 years. Fantastic, right? This is what they say, that we should stay invested for at least 5 years, and almost everyone in this hall has done so. Just a quick show of hands. How many from outside Mumbai? Oh, fantastic, fantastic. I should also raise my hand. I'm from Pune. Anyone's going back there, I can hitch a ride. But with that, we can get to the questions. So first, let me ask about the large cap fund. This has been the debate on social media quite a bit. First, given that you have a Swiss Army knife philosophy, couldn't you implement these strategies in the flexi cap fund?
So, one interesting point that a lot of investors have made in person, on social media and elsewhere, is that they invest with our FlexiCap, and apart from FlexiCap, they also invest in index funds. So some people say that we invest in index funds and FlexiCap. These are all the investments that we have. A lot of times people say that how much of my money can I put in one single scheme, FlexiCap? I love it, but is there something different that is there? End of the day, you are selecting individual stocks, you are deciding how much allocation goes towards equities. If opportunities are not there, you stay in cash. Ultimately, you are one way or the other subject to human biases and things like that. And almost since 2013, people have said, do you have plans to launch a passive fund? Like our thing was, there are maybe 25, 30 Nifty 50 index funds out there. If we launch one more, what difference will it make to the world? Why should anyone invest in our Nifty 50 index fund? So that idea never really excited us. And from Parag Bhai's book days, so his books, Value Investing, Behavioral Finance, and Stock to Riches and all, he's been looking at the index. So in fact, in a book he's mentioned, he's done this study, performance of stocks that come into the index and performance of stocks that go out of the index. So the discussion was, if we are not going to come directly in the passive space, is there something which we can do which is rule-based, which does, again, this whole concept actually, there's a minor infuriation that I have. Rukun mentioned in the presentation, the press release is put out 15 days ago saying this stock will come in and this stock will go out. And even before the official press release, people do these, they call it alternative research, not just for Nifty, but MSCI, this stock will come in, this stock will go out, this weightage. So effectively, to this small extent, index funds are patsies. They are the people who give free money to all these traders and arbitragers who officially front run them, because the index notification is in the public domain and the actual rebalance happens 15 days later. So why should the end investor suffer that impact cost every time rebalancing happens? We said, let's do a differentiated play. So actually this presentation that Rukun made, in some form we had made 4 years back at our internal event, and this idea has been there forever with us. Yeah, somewhere the thought triggered that if people want something which is different from, so this is what FlexiCap is not in a way. So FlexiCap is relatively higher weightages to fewer number of stocks, go anywhere. It can be in cash, may not be in cash. This is index hugging, 100 stock portfolio, but does things which index funds cannot.
So you haven't used the term passive plus, but perhaps I could coin that term. But in your back tests for this fund, have you got some indication of how much excess return it can deliver over a pure play Nifty 100 passive fund?
So firstly, we can't guide on any returns or things like that. And so there's this famous quote that is popular in the quant community. They say that there has never been a back test which looked bad, right? In back tests, everything looks good. Here, see, a lot of people say that so many active investors underperform as compared to the benchmarks. What people don't talk about is almost all passive funds underperform the benchmark. Why? Because the expense ratio is there. Now, if with smart execution, with some of these active strategies vis-a-vis the futures or merger-related arbitrages, and if we can recoup some of the expenses that are inevitable in running a low-cost fund, And if we can generate something better for the investor, that's the objective. So again, here the objective is not to create huge alpha. If someone is looking for an actively managed strategy which differs very much from the benchmarks, then FlexiCap remains the equity strategy to invest in.
Now, the one issue that is foremost in investor minds, not just in India but globally, is the valuations of US tech stocks, Mag 7, etc. So I'm going to take that as the first question. The question is that in the event that Alphabet, Meta, Amazon, Microsoft become expensive, will we consider shifting those to debt or continue to invest globally? Mag 7 is similar to Nifty 50 back in the 70s, so US Nifty 50, not India. And are we comfortable with the concentration? Are we comfortable with the valuations?
Sure. I would split the Mag 7s and the expensive stocks in the US in two categories, or the stocks in the US in two categories. Again, this argument to some extent is self-serving, so people should be aware that maybe I'm biased here. But the companies that we own, Alphabet or Google, Meta or Facebook, as it is, Microsoft and Amazon, these are businesses which earn a huge amount of cash flow. Sure, they are plowing back a lot of that cash flow into capital expenditure and buying chips and setting up data centers and creating all these models and all. But they are unlike the other companies that typically we refer to when we talk about the bubble. So OpenAI, for example, has created this wonderful tool, ChatGPT, but each and every day, each and every month, they are burning cash because their revenue is far short of the expenditure that they are incurring. Or the companies that we own are unlike something like a NVIDIA, which is dependent on that semiconductor chip cycle, demand, pricing, margins, all of those things can vary. And again, a lot of these hyperscalers, companies like Google and Amazon, are creating their own special purpose AI chips, ASICs, as they are called. So maybe that will dent NVIDIA's demand down the road. Here, Google is dependent on YouTube, which people are still streaming and probably watching the live stream on YouTube in many places right now. YouTube is the new MTV for people in terms of music streaming. They are into cloud computing, digital advertising. You have the side bets that you get in things like Waymo and all. And when people say Mag 7 is like Nifty 50 of the US of the past, the multiples are not in that range. So when people actually look at the numbers, people are surprised. These are 20, 25, 30 times earnings trailing. And again, there's a lot of cash on the balance sheet, or now they have started raising some debt for capital expenditure. But these are not conventionally very, very expensive. Again, a random data point. We have been owning Google for a long time, but Berkshire Hathaway recently disclosed that they have picked up $5 billion stake in Alphabet recently. So if it is Nifty 50 kind of bubble valuation, then one would not expect Berkshire to create a fresh investment there.
So I'm going to stick with the IT theme for a bit. How do you assess the outlook for IT companies in India as they are struggling with growth rates? Given that IT companies don't need to reinvest their cash flows and pay out 100% to shareholders, will it make more sense to look at them on yield as high ROCs can't compound?
Anak, you want to have a go, and then I'll add.
Sure. Thanks, Neil, for the question. IT companies, the growth rates that people refer to, generally people tend to look at a shorter term growth rate because that's the most obvious and recent that they can track. But generally, if you just zoom out a little bit, do a 20-year view of IT companies, how the smaller companies were at one point, how big they have become today, the growth rates are also very, very cyclical. And the reason is these companies are contract people. They are contracted for doing a particular job, whether it's application development, whether it is deploying something on the cloud, whether it is infrastructure management, or various other IT work that is required for any client. So that cyclicality comes in because the budgets of various client companies can be different. So over a period of time, what we have seen is IT companies have diversified their business. The biggest market share or the revenue share used to be banking, financial services. That is now maybe a little smaller compared to it was in the past. Manufacturing has picked up, medical healthcare has picked up. You will see segments like your cloud computing, so legacy technology can be modernized to a new version. That has picked up. So all of these revenue streams, these companies have had over a period of time. So the cyclicality comes from their end customers' ability to spend money over a period of time. When most companies are doing well, most clients are doing well, you will see them spending a little bit more of their budgets on IT. So that period generally might have disproportionate growth rates in some of these companies with their contract service providers. In some cases, when you have disruptions in technology, where nobody thought cloud will be a big part of their investments as an enterprise customer, and they wanted to invest, you will see spurt of growth coming in. And that will naturally also mean old business little bit slowing down, and you will see moderate growth rates. So growth rates should not be looked at from just a 1 year or a 2-3 year cycle. It's a longer term trend in technology, which these companies facilitate their customers to pick up on and invest in their existing businesses. From a cash flow point of view, these companies earn their business when they consistently keep delivering these projects. So if you see the history of all the listed IT companies in India, most of them have had positive operating cash, positive free cash, and they have not had the tendency to give back most of it. So you would have seen a lot of cash holding in the balance sheet over a period of time. But nowadays, in the last 6-7 years, that trend has little bit changed. People are giving out more money to shareholders because they don't have the reinvestment avenue. So this is basically, after their reinvestment, whatever money is left out, they are giving it to the shareholders, which is a good thing, which is the nature of their business. So I don't think IT companies in that way struggle with giving out cash or reinvesting. They are doing both, in my view.
Yeah, so people have written off IT services companies many a times in the past. So something like SaaS was supposed to be the death of Indian IT. People said you can just pull out a credit card, go to salesforce.com and automate your CRM, and that is the future. Why will we require armies of people writing out custom code in India? Cloud was supposed to be the death of Indian IT because a lot of back-end operational work will no longer be required. But I think each cycle has been bigger than the previous one, and a lot of we find humanity thinks of new things to do, and even with AI, I think we'll figure out a lot more things which need to be done. So sure, it will improve the productivity of people writing code. So the IDE environments are becoming more and more powerful. So Google has just recently announced a new tool, anti-gravity, for using AI to create software. But I think you'll still require people to do it. The AI bros have been saying IT will take away all the jobs for a while now, but I don't think I'm that pessimistic. We'll see how things go by.
I asked you this earlier as well when we were discussing, but I think it's important that everyone else also gets to hear the answer. Why not invest in global stocks beyond the US? China, of course, looms large. The question is that given the softer stance indicated by the US towards China in recent times, do you really see this still as a very high-risk market?
So I have a 1-hour talk on Chinese companies and the Chinese environment on our PPFAS YouTube channel. So people who are interested to explore this in deep could take a look at that. But very briefly, the best sectors in China, which are the fintech related or the technology related or e-commerce related sectors, EV kind of companies, these sectors are banned for foreign investors. Foreign investors cannot legally own stakes in these companies. Now, this may be surprising to a lot of people. People say, oh, but you can buy Alibaba ADRs or you can buy them in the Hong Kong market. What people don't know is when you buy ADRs of Alibaba or Baidu or Tencent or these kind of companies, what you are buying is you are buying depository receipts of typically a Cayman Island company, which is not the operating company. It's just a shell company. This shell company, in turn, has a subsidiary in mainland China. This subsidiary in mainland China, again, is not the operating company. It's just a company with a similar name. Now, this mainland China company has a side informal agreement with the operating company to share some of the economic profits of that operating company. So the owners of these ADRs have no voting rights or have no business interest in the actual operating company. And in the past, Yahoo used to own a big stake in Alibaba. And at that time, the financial activity were part of Alibaba. This financial unit was spun off and it is now called Ant Financial, and it was a very valuable piece of Alibaba. This was spun off without taking consent of Yahoo or even informing them, and it was arguably spun off at a very, very low cost. So the ADR owners of Alibaba actually suffered because of that. Again, the governance practices in a country like China have not been that great. You would have heard about Jack Ma being in hiding for a long period of time after he got into trouble with the regulatory authorities there. There are books about the Russian market. There are books about Chinese market. Red Notice, Red Roulette are two famous books. In South Korea, the most famous business people have gone in and out of jail numerous times. So largely when we invest globally, we stick to North America, Western Europe and developed Asia. So developed Asia is largely places like Japan and all. We would rather be safe than sorry. We have no wherewithal to go and fight court battles elsewhere, even if that is possible. We would rather be safe than sorry. The companies that we are buying, even though they may be domiciled in US or Europe, these are global multinationals. So Microsoft sells software all over the world. So although it's an American company, but essentially you are getting global diversification.
Now, there's a question on cash holdings. You've already answered that in the presentation. But I suppose one twist to it is that why haven't you considered investing in defensive assets like gold when you believe that the value available in equity markets is not that great?
Sure. So, 2 or 3 things I wanted to mention about gold. One is FlexiCap doesn't have a allocation to gold as per the offer document, or we are not allowed to buy gold, silver or commodities. That is one. Till very recently, we always maintained this. For a retail investor, the best way to own gold was via sovereign gold bonds. There was no expense ratio on that. You were paid interest to hold those, and capital gains was tax-free. So for the longest periods, we said, use that if you want gold exposure. Don't depend on us to do gold investing with you. Of course, now SGBs are no longer available. So people who want gold allocation should look at something like gold ETFs or multi-asset funds. FlexiCap clearly is not in that space. And so people keep asking us about views on gold, silver, platinum, Bitcoin, Ethereum. See, these are assets which I call beauty in the eye of the beholder assets. What will be the price of gold 5 years from now depends on what 2 individuals will transact in the market. Inherently, there's no cash flow from these assets. What we are equipped as financial professionals is to value assets based on their earning capacity. So if we are looking at a commercial real estate block, we estimate what rental yields this will earn. If we are looking at warehouses, aircraft leases, listed equity, private equity, bonds, we can estimate credit risk, chance of default, all of that. But gold, largely it's been driven by central bank buying and what happened between Russia and the US, where Russian assets were taken away and then central banks started reducing the dependence on US dollar. So it's not something which one can model in terms of how much percentage should be in gold or what is the outlook for gold.
So you touched upon IPO investing in your presentation. But if you could elaborate a bit, have you subscribed to IPOs in the past? If so, which ones? And going forward, do you rule it out or would you do so case by case?
We have subscribed to 2 IPOs, CDSL and CAMS. Anything else that? IRCTC was the third one. So, yeah, HDFC AMC. So 4 IPOs we have subscribed to. It depends on the chances of allotment that we see in and the attractiveness of the IPO. But typically we have been not big investors in IPO. As I mentioned, one would, so again, things like IPO coming from the House of Tatas or from the HDFC group or ICICI group, these are known entities and it's not some first gen family business which is coming for listing. So some of these surely one can participate in. But otherwise, typically we will want to look at them as a listed company and watch them for a while before deciding to invest in some of these.
You mentioned again cash levels, but one of the questions is that while the fund has been very resilient over the past years, the scheme looks more like an aggressive hybrid fund with 25 to 30% in debt and cash, etc. So while valuations might be high in some pockets, specific stocks in other sectors would be undervalued. So why not pick those?
So we have, when we have, let's say, 25% cash, we have 75% which is deployed. And that 75% is deployed in things that we find reasonably attractive. But things that look attractive or sectors that look attractive, we would have certain comfort level in terms of individual stock exposures or sectoral exposures, and we may not want to go beyond a point. So for a while now, we have been saying banks look reasonably attractive in terms of the valuations and the balance sheet quality, etc. But we have internally capped banking exposure at 20%. So around that, we typically stop purchasing. Or generic pharma companies, we have said we would be fine with having a diversified exposure to generic pharma companies, but typically we restrict it to 1/4, 1.5% kind of thing per company, because some US FDA alert or after some inspection, they may say import is banned from this facility or new product approvals will not come in, or sometimes a price war breaks out in some generic molecule. So, yeah, whatever we find attractive, we buy, and up to a certain portfolio weight. So, let me slightly expand the question. A lot of people think that today we are at 25% cash or 23% cash, whatever the number is. And last year also it was more or less the same. So people would think we have done nothing in 1 year. In 1 year, actually, we have added stocks, and we would have sold down things which were looking extended. So we have exited our capital market exposures, for example, and we have added things in auto. So we added things like Mahindra, or we added things like Bharti Airtel, we added a small cap company, Zydus Wellness. So we have been active both on the buying as well as selling side in that sense.
Next question is for Neil. It's one of the perennial favorites. So what are your plans for a potential IPO? There has been euphoria in the unlisted share price of your company in recent times.
Yeah, so obviously we've given ESOPs to our employees, and also if you see the unlisted space or even our shares in the unlisted space, those have actually gone up or appreciated quite a lot in the last 2 or 3 years, you know. The plan is that, yeah, we probably are looking at a listing, but about 5 years from now, in 2030. Reason for that is that, like I said, we've given ESOPs to employees, and those will mature, or those will vest in 2029-30, the last batch of those. And when that happens, then we thought that then that's probably a time to look at the IPO, because listing before that will be a very big tax outgo for the employee, you know, because right now if you're an unlisted player, your tax is on, you can just pay your tax on the net worth of the company, you know, the book value of the company. But if it's a listed, if it gets listed and it lists at quite a bit of a premium, then that tax on the employee is a lot. So we're like, let that all happen. Like we mentioned, we're pretty patient people, and we don't know. I mean, again, that's the plan. I don't know if it's going to happen, not happen, but yeah, we are actually now fine that we could list in 2030.
Fantastic. So we have a date, and I must once again ask: is there going to be unit holder quota?
I don't think it was permitted in the earlier AMCs that got listed. So if regulation permits it, more quota for longer holding. So 2013 investors get maximum, lower for 2014. That's it.
Yeah, 5 years is quite a long time, so maybe things change in those 5 years. So we'll see what happens around that.
The second perennial favorite for you, Neil, is how long does Rajiv Thakkar continue to work for, and can we...
I am very, very grateful to unit holders for helping me by asking this question each year. It helps me a lot. Please keep asking this every year. Thank you.
Yeah, so, I mean, if you see him right now, he has no white hair. So I don't know where the retirement talk is coming from. He's still a young guy. I think we've got decades more to do. In my presentation, we laid out all the plans that we have and the things that we want to do, you know, and a lot of these things will probably take time. And yeah, it's an exciting phase. More than anything else is we enjoy doing what we're doing. We enjoy each other's company. I'm taking the liberty to talk about all of us here that it's a fun environment. We are not only serious, we laugh and joke quite a bit, and yeah, it's a fun environment. We like doing what we are doing. We all think around the same way, you know, in terms of goals and where the organization should go. So yeah, Rajiv can work here as long as he wants. So I mean, yeah, we probably have that conversation sometime in the future, but not right now. Right now we have so much stuff to do. And it's an exciting time, and we don't want I don't want any of our headspace to go into negativity or uncertainty and all those things, you know. So as long as it's going good, let it go good.
Just yesterday, I think you broke a story about one of the FlexiCap managers leaving. So again, we get all the love. So I've been here for 24 plus years now, and still we keep getting asked this question, whereas other fund houses, people come and go all the time and no one seems to be bothered at all. So thank you. Please keep this coming. It helps a lot.
All right, next two questions for Raj. So can you talk about the last 1 year performance of the Dynamic Asset Allocation Fund, especially since it's a retirement product, according to the questioner? Also, any thoughts about increasing the equity allocation?
So since the time we launched the fund, we have communicated this to the investors that we do not intend to increase the core equity exposure within DAF. So we look at DAF as a retirement product, as the investor said. So the core equity exposure, we try and maintain between 10 and 20% depending on the valuations. The only thing that changes within DAF is the arbitrage exposure depending on the spreads that are there in the market versus the fixed income yields that we get. So the total equity exposure will range between 35 and 65%. That includes both core exposure plus the arbitrage position. So there is no intention on increasing equity exposure within DAF. There are some concerns on the returns in the past 1 year, but if you see the returns, they have been around 6.5%, which equates to the YTM that is there in the fund. So I don't think there's too much concern on the returns over there. And past 1 year, as you would have seen, the equity returns haven't been good. So because of which it takes away some of the returns from DAFs.
On the related note, Recently, SEBI classified REITs as equity. So will we see DAF adding REITs exposure as well? And in other schemes, why is there not substantial increase in the REITs allocation?
So there is a Gazette notification which says that REITs are now classified as equities, but we are awaiting SEBI regulations on the same and the details on which funds are allowed to invest in it and how much they are allowed to invest in it. Coming to the exposure, so conservative hybrid fund already has the max limit, which is 10%, which is allowed right now in REITs. In DAF, we are not allowed to invest. In FlexiCap, there is a minuscule exposure given that we are using it right now more as a proxy to cash, and whenever opportunities are available, we should be able to switch from REITs to equities. So that's why you have a smaller exposure there.
Any possibility of merging the CHF and the DAF?
So let the notifications come. It's, I think, early, but we'll see as and when that situation comes. First step would be to include REITs in DAF, and everything else will follow after that.
Staying with debt, what is the rationale behind amending the SID of the liquid fund to include securitized debt? Most are gold loans and auto loans bundled out with fancy credit grading and carrying high credit risk. You are aware of the damage caused by the instruments in the global financial crisis. Are you going to include these in the CHF and the DAF also?
So the short answer is no. We've not invested in securitized debt previously, and in future also we will not. There are two categories in liquid fund SID when we have to classify. One is money market, which is predominantly CDCP, and second is debt. Now the debt includes corporate bonds, NCDs, as well as securitized debts and other instruments. So we do invest in corporate bonds, say of the AAA companies which are in our universe, but we do not buy securitized debt. We buy less than 3-month maturing corporate bonds. So that's why the classification that it just includes securitized debt, not necessarily we will buy.
They're just sticking with you for the next question. Given the recent overhaul of the debt management team, including the appointment of a new CIO, what is the expected stability of the debt team over the next 2.5 years? What schemes has the current CIO previously managed and what was their track record? Whether any further structural or personal changes are planned that may affect holdings on the debt side and DAF?
So let me first answer about myself. So I was with SBI Mutual Fund before joining PPFAS, and I was looking after dynamic and gilt fund, predominantly active funds, and coupled with passive and overnight funds. Track record, you can check it online from the period I was managing. In terms of stability, of course, the idea is to stabilize, increase the team. As Neil said, that we want to focus on debt. We've got a lot of feedback from corporates that we believe in your philosophy, we believe in your SLR. So we follow SLR framework, which is safety, liquidity, and risk when it comes to debt investments. So we believe in that. So we want you to come up with debt schemes also, which helps us in our cash management, in our corporate treasury books. So that's where I come in picture. Of course, the idea is to increase the stability, have a debt schemes of in across a segment wherever we think that we can deliver to possible investors. Sorry, the next part was about the strategy. So strategy remains same for the existing scheme in DAF or CHF. There will be no change in terms of investment philosophy, in terms of so we predominantly invest only in AAA and SLR securities. The strategy will continue to that. We've communicated that to our investors in past that these are debt-oriented product. The risk management aspect remains the priority. Return optimization is the second step. There is no change from that perspective.
Just adding on to that though, in DAF and CHF is predominantly SDLs and some PSU debt, right?
Yeah.
So given the compression in yields, why not go a little bit beyond that to get some excess yield?
So see, I genuinely believe that fixed income is a risk management product and not return optimization. The moment you move from your core philosophy of risk management, try to look for asset to optimize for specific or not even substantially higher carry, you tend to lose out on your capital. Okay, we don't want to do that. We want to remain invested in AAA. We will continue to do that. Of course, when in terms of corporate bond allocation, AAA corporate allocation and SDL allocation, when the spread compressions happens, we move from corporate bond to SDL or vice versa. And we've done that in last couple of months. If you would have noticed in our fact sheet, we reduced our corporate bond allocation from 25% to 10% because the spread compression happened. So there we do, we rebalance the asset allocation, but adding extra names or adding companies into a universe just because they are giving some extra spread, I don't think so that's a good strategy, and I don't think so we will do it also in future.
Yeah, just as a, so Tejas of course is representing his team on stage, given that we are short of space. Mansi and Aishwarya, his colleagues in the fund management team, are right there. Maybe you guys can wave out to the audience. They're right there. Say hello.
All right, next two questions for Rukun. The first is, I guess relates to the large cap fund. How does one value a company that's getting demerged? Can you elaborate more on that strategy?
So, from the large cap funds perspective, the demerger part was just to highlight that when a demerger happens, very likely one of the two companies goes out of the index, which creates a temporary selling pressure, which an active fund need not transact on the rebalancing date only and transact gradually. So you're not necessarily selling on the worst date. If it is other than large caps, the way you value demergers is the way you would value any other firm, wherein you look at the cash flows of the firm, the balance sheet, and try and arrive at an estimate for a value of that firm. The thing that makes demergers interesting is that unlike IPOs, as Rajiv mentioned, wherein there is a huge team trying to price it and there are willing buyers of the IPOs, in case of demergers, a lot of the holders have just end up receiving the stock when they actually don't want it. Many of these holders will then end up selling that stock irrespective of the valuation that it is trading at. So a lot of times it can create pricing inefficiencies, which by due diligence you can take advantage of.
The rationale behind investment in Nesco.
Sure. So Nesco, as a lot of people from Mumbai would know, has two main businesses. There is an exhibition center and there is a commercial real estate part of it. Now both of these businesses or both of these are located on prime city center land that's very good connectivity, near to the metro, on the Western Express Highway and so on. Recreating these assets would take a lot of capital for anyone wanting to recreate either the exhibition center or the commercial real estate. There's also a lot of optionality that is there from whatever new businesses they are incubating, like events, food and so on. And when we were buying that, we felt that the market was not fully valuing the current market value of these assets, whether it was the exhibition center or the commercial real estate.
Next question for Ronak. Currently in the flexi-cap world, there are companies like Geo BlackRock, Capital Mind who are using AI ML and other data to create their portfolios. How will you make sure that you'll be able to win in this AI world?
So I don't know what winning actually means in the AI world, but I know that if some tool is available which is going to make your job easier in terms of doing research or even maybe allocation in the future, I think we should take full advantage of it. So if you look at the research team today, although we are growing the number of research analysts in our team as well, at the same time we are also allowing them to use AI tools to maybe reduce some of the tasks that they would do to fish out information, to summarize information, to transcribe information for them. And maybe these tools can help them do more work in the same amount of time that they have, and maybe reserve that time for more analytical work rather than doing just the rote form of reading and learning. So I think these tools are there, which have come up in the recent past. They actually supercharge some of your activities. So if you can do that in your day-to-day task, And again, we can use several tools. It not necessarily means that only one tool can be used or one company's product can be used. Allow different products to also incorporate AI features into them, and they can also help you enhance your work. So one product that our team uses is Screener, which also has the AI summarization tool now, which is again a very useful addition. Many of the database solution providers also have AI incorporated into it. Now, AI is a very broad encompassing term, but it gives you the ability to do some of your tasks faster. So from a research context, from the investment team's context, whatever advantage we can get from these tools, we will be willing to use it. It's like saying 20 years back when Excel was a prevalent software, why use Excel when you can just use your head to calculate everything? Why? I mean, if you want to use and quickly do more work, you can use an Excel sheet and do it for hundreds of companies today. And like Rajiv was saying, the number of companies which are coming on IPO in India, abroad, that number is not reducing. It's, I think the task is even daunting, the amount of breadth of coverage that we need to do. If some of these tools can help us do that better, I think that is one way to win, I would say.
Next question again from you, perhaps the most old-fashioned way to do research. Is it important to visit companies at ground level? How do you manage this with so many stocks in your portfolio?
Sometimes yes, and sometimes no. So I would love to keep going to Google's campus, Rajiv, if he allows me to do, but I don't think there is too much value addition to go and meet Sundar Pichai or Google's team. But there's a lot of value addition in some smaller companies where you need to know whether the plant actually exists or not, or whether if you have seen a plant of a competitor company, how this plant looks like and what is the size of the plant. When someone says you want to spend 1,000 crores on building some asset, what does 1,000 crore actually buy you? Some of these things are worth looking at when those companies are of that nature, where physical assets are required to be visited. But I don't think it is required for all companies. Like if somebody says, if you own a bank, like Rajiv said, we own 20% of the portfolio in private sector banks. What will you do visiting the corporate office of a private sector bank or even a branch? Maybe you learn something, a nuanced way of how they operate and do differentiated things as a customer. But beyond a point, there is no benefit. So it depends on context, depends on sectors, depends on companies. So the old-fashioned tools are always available to use whenever we need to use them.
Just to add, we also have a very large research team. So while there are a lot of companies to cover and we want to do, as Ronak was saying, wherever necessary, we need to do those plant visits, but there is a big research team as well which does those wherever required.
Ronak, your view on specialty chemicals now, do you see signs of upcycle and how do you see China Plus One panning out?
In some pockets, the upcycle exists, and that is because of the companies which have gone up in the value chain. But again, the capacity addition in some of those sectors has been so lopsided towards China that whenever people talk about China Plus One, that has not really panned out the way most companies or most promoters who had said it will pan out. Again, kudos for trying to do that, because it's a formidable challenge for most Indian companies to compete with a capacity which comes up at that cost and even at that price point for some of the commodities. But as companies are upgrading their position in the value chain of products they are selling, you are seeing some of those things happening. But unfortunately, with any sector, I would not say a bubble, but the kind of demand for some of those stocks in that sector actually peaked out a while back, even before the capacity came up. And once the capacity came up, the growth is visible, and yet the market will not value it because the future of that sector does not look so promising. So there are very interesting companies in that space. We do keep tracking them. But the interesting part is we need to be conscious about the diversification of the products that they have, whether it is from a risk point of view better to invest in those companies or not. So we'll keep a watch.
Next question for Rajiv. The rationale behind buying CMS Infosystem when people are using UPI for payments and usage of ATMs is going down?
Sure. So UPI has been one great success story of India and the wonderful payment ecosystem that it has created. It hasn't displaced cash overall, however. So people are surprised to know that the currency in circulation that is there in India today, as a percentage of money supply or as a percentage of GDP or whichever is the favorite metric, this is larger than pre-demonetization days. So despite the demonetization, despite the success of UPI, cash hasn't gone away. It's just that the UPI transactions are far greater in number and the biggest impact has been on debit card transactions and to some extent on credit card transactions. Is it a great growth story? Answer is no. Maybe growth will be slow over a period of time. What has also happened is consolidation has happened in that space. So one of the competitors actually went bankrupt and shut shop. So the number of players empaneled with banks and who have that the security system and the infrastructure in place, those companies have gone down in number. So competitive intensity has come down. Apart from cash management and replenishing ATMs, they are also doing a lot of other financial services related activities. So over a period of time, one would expect that to be a bigger and bigger portion of the company's business. And valuations again remain reasonable.
Next one for you again. Execution behind Power Grid seems to have been weak. What are your views on the same?
So whatever excitement people have around the energy transition, to my mind, that cannot come about without a robust grid infrastructure. So whatever shortcomings are there in power grid, that will also have a downstream impact on the renewable energy space. So people would have seen the media headlines where a renewable energy or a solar energy park has come on stream, but it does not have grid connectivity. So although everything is in place and they've spent the money creating the infrastructure, the power generated is not being used currently. There were certain industry level challenges. So one of the biggest industry level challenge was right of way. So when you see these huge electricity towers and the huge cables going across land, the person to whom the land belongs to has to be made a certain amount of payment, and some consents and all are required to be done. So the law was changed around this, and the payment to be made to the landowner was increased. Now this is not specific to power grid. This is not specific to power grid, but across the industry. Now around that time there were challenges in setting up additional grid capacity. Hopefully that should get resolved, and there will be more capital expenditure coming online, and their profitability can increase. Another point to note specifically in the grid assets is that earlier you had, let's say, a thermal power plant which would generate electricity on a predictable basis, and that electricity had to be transmitted to the consuming areas. Now what has happened is a lot of intermittent generators connect to the grid. So windmill, solar energy, all these solar generates only for certain hours in a day. Windmill depends on the seasonality and the how much wind is blowing. Again, the generating assets may be far away from the consuming areas. In the early morning, the eastern part of the country will start generating faster. Late evenings, the western part of the country will still be generating. So power is to be distributed over long distances, and increasingly power will also need to be stored. So whether through pumped hydro or whether through battery energy storage systems. So in all this, the grid will play an integral role in making sure that we gradually move away from fossil fuels, and even transportation comes on electricity, and even data centers and the like.
Next question for Ronak. We've built up positions in pharma this year, but our overall allocation is less than 4%, with each pharma name at roughly equal weight. Was there any thought of increasing the exposure to, say, more than 5%, especially now that valuations have cooled off and we're sitting on decent cash?
So we don't look at pharma from an overall portfolio allocation point of view. It has generally been small. Sometimes it has even been 6% in the past. The idea behind pharma stocks, I've mentioned this several times in the past AGMs also, I'll just summarize it quickly, is that to have a basket approach in having pharma companies where one or two companies' future, if you cannot predict too meaningfully because of any issues, because of an FDA warning on their plant, or because of the company's products not doing well, but the overall theme of those companies that we have in the portfolio is more or less similar. These are generic pharma companies who export products to many parts of the world. US is a dominant part of that, and they have a pipeline of products which keep releasing based on the patent, based on the other pharma products going off patent. So that also creates a natural pipeline of new drug launches. Their job is to basically make sure they have a generic version available in the market, they are filing that product and being able to market and sell in different parts of the world where that product is bought. That is one way. Second is these companies should have even a domestic business. So most of the companies we have owned in the past in the pharma basket also have an India business which is growing. They have a product portfolio over the counter, which is OTC portfolio, which sells directly to the customer without a prescription. That also has to be there. And third, companies should have basic financial characteristics like a very strong balance sheet to take advantage of opportunities, strong cash flows consistently over a period of time, and management's willing to give out cash in the form of dividends. In the past, we have seen many companies do that. So if all of these conditions are met and you are not able to predict the business outcomes of some of these companies individually, it doesn't help to have a very large position in those companies. So build a basket of companies, and within that basket keep adding, selling, buying over a period of time based on valuations, based on other investment factors that we consider. So that basket approach will continue in pharma.
Next question to you. What was the logic behind buying Narayana Rudala? Rajiv has always said that they want to stay away from highly regulated sectors. This company does not have a dividend yield like Coal India.
So why would we buy a company which is in the sector which has a lot of public outrage possible if something goes wrong in that? And Rajiv had mentioned in that context in the past that hospitals are generally bad because if you price a service too expensive, then there can be a fallout in terms of bad reputation. But a company like Narayana Rudala, without praising them too much, they have done a good job in terms of maintaining a low-cost approach to providing healthcare services to their patients across whichever hospitals they have operated in. Secondly, the company was a recent IPO, so we needed some time to understand how the capital allocation happens, how the promoters behave, how the management teams are scaling. Because once you are a corporate entity, you also need to make sure that apart from doing your servicing of healthcare, you also need to run a business properly. So they have demonstrated that in the past that capital allocation is quite sound in that business, and they are not deviating from their core message of providing low cost or reasonably priced healthcare services to their patients who come in. Thirdly, and very importantly, the management team has been very strong in this company, and we continue to see that they demonstrate their execution very well. Unfortunately, the valuation in this sector across various hospitals or healthcare services companies has not been very attractive. At one point, this company did come in a very attractive price band, and we started allocating. But again, the price band went out of our comfort zone, so we have not added anything beyond that. But it's a well-run company. It falls within the ethos of a well-run business and run by competent people who are honorable people as well. We'll see when we get a chance to build a position in that.
Next question for Rajiv. What are your views on IEX vis-a-vis market coupling? Can any parallels be drawn from similar coupling exercise done globally, Europe or US?
Sure. So the bull case is well known, the bear case is also well known. It's been in the public domain for a while now. At one end, the predictability of power generation has reduced with intermittent sourcing coming in, solar and wind largely. And again, like I said, east to west, long distances have to be covered, time of day matters. So late evenings, there's a big spike in demand, offices haven't shut down, residences start lighting up and air conditioners start going up. Afternoon, lot of solar generation is there, lot of excess supply is there. All these things are there. So it requires trading of electricity. The traditional long-term PPA is gradually losing dominance to traded power. IEX has been the dominant player in this space, so obviously it is an attractive business to own. So this is the bull case for IEX or the power exchange. For a while, the regulator had been mulling, forcing something like a market coupling, where the same price is available on multiple exchanges, or the end clearing price is the same irrespective of where the transaction happens, which exchange. The notification came 1st Jan 26 is when market coupling is supposed to begin. And that caused a big sell-off in the price. So we used that as an opportunity to buy some more stock. So for one, the notification came from a regulator saying 1st Jan this happens. Now, for whoever has developed any meaningful software, that person would know that it's not as easy as typing out a circular. So to my knowledge, I'm not even aware of who is the software vendor, who will develop, what are the specifications, what are the business documents, process flows, user access testing, then taking customers on board, all of that. After this notification came out, there were a few conference calls with the competing exchanges. The competing exchanges were obviously excited that something like this is being proposed or what has been said by the regulator, but they did not have a clear answer as to how this will work. Some of them said maybe it will require each client to have margins with multiple exchanges rather than keeping it with just one exchange, because there was no clarity on how margin portability will work. So just because a new exchange comes in doesn't mean that market share will be 1/3, 1/3, 1/3 if there are 3 exchanges. And I don't think it is happening on Jan 1, 26. So we will see how things pan out. As it turns out, some of the people in the meeting where the coupling happened actually had traded in the futures contracts, and there was a SEBI order to that effect, alleging insider trading and all of that. So again, all of these are outside the company itself. The underlying business seems to have a long runway. Whether the market coupling will happen, not happen, when will it happen, what will be the market shares, all these are uncertainties and will remain to be seen.
A couple of questions on the ELSS fund for you, Rajiv. Given the much smaller AUM of the tax saver scheme, why isn't it taking more significant positions in names like Nesco, Narayana, EID, Perry, Zydus, where the flexi cap had historically taken a much smaller position, less than 1%? Why didn't the tax saver take a bigger position in these names? What is the point of positions that are less than 1% of AUM?
Sure. So many a times these things come about that when you start buying something, the price wiggles. And this doesn't happen all the time. So just the previous question you asked on IEX. IEX, we were 5% owners in the company. We bought an additional 2%, we went to 7% ownership in the company. We disclosed it to the exchanges. There was not any meaningful difference in the stock price. We kept buying more, we went up to 9%. So it's not that every purchase of PPFAS causes a price spike, unlike what people think in the marketplace. We are able to do our buying selling normally in most cases. Sometimes because of some other factor, either the company announces something or some broker puts out a buy report around the same time, the price moves significantly when we are buying or when we just start to buy. In which case we don't chase the price and we remain with a low allocation. To some extent the point is correct that the ELSS has a much lower assets under management than the flexi cap. Also flexi cap has 11% in overseas stocks. Flexi cap can have more cash. ELSS is supposed to be 80% invested at all times. So to that extent, ELSS has some extra stocks which are not there in the flexi cap. So that will happen periodically. So sometimes these situations will come about where there's a minuscule allocation, but typically we would not expect that to be the case.
Next one on Coal India. Since you increase allocations there, the selling price may not be a clear re-rating driver. it must be volumes which drive cash flows. With such significant capex plan, how do we draw comfort since the company has supply bottlenecks? While coal consumption has a 7-year golden period in the front of it, why is Coal India an obvious choice for the fund? Because here the competitive intensity is increasing, and given bottlenecks in transport for Coal India, this accentuates the market share loss. So how do we draw comfort from this investment?
Sure. So bulk of the coal that Coal India sells is at a regulated price. Only a small portion of it is as per auction price, e-auction prices, which are higher than the regulated prices. So there is some leeway for regulated price to go up in line with inflation or in line with some cost increases, etc. While private mining licenses have been issued, Coal India remains to be one of the efficient producers, and India still imports coal. So although the coal import has come down over the years, still it has not gone away. So while domestic coal production can increase, this company should not see a volume decrease. It trades at around 7.5 times earnings. So if you look at just in terms of payback period, the company should earn its market cap by way of profits in 7 years. So the question is correct. They are incurring capital expenditure. A lot of the capital expenditure is also towards the energy transition. So they are investing in renewables. They are investing in some things like coal gasification. So now a lot of people think that carbon will not be required once renewable energy comes in. But carbon is required in a lot of industrial processes. So like methane kind of thing would be required in fertilizer production, for example, or in some other industrial things. So coal bed methane is one of the things that they've been exploring, or coal gasification is what they have been exploring. They have been exploring storage kind of things. Rare earths is another area where they have been doing some exploratory work. So while someday there will be a situation where we will not be burning so much coal to generate electricity, but I don't think the company is going away or that the terminal value is zero very, very close. So I don't think that one should be that pessimistic about this.
Next question for Neil. Thoughts about specialized investment funds, SIFs, also about multi-asset funds where you can have, or ETFs in gold, silver, etc., or a hybrid fund?
Yeah, so SIF is obviously the special investment funds which have, I think some have just been launched right now by a few fund houses. So our strategy there is that we're not launching anything in the SIF space right now. We're going to wait and watch what other people do and what kind of funds they come out with. And in case there's a need, again, from our fund house to have an SIF where we can, like we said, that if we can meaningfully differentiate, or if there's some good opportunity that we think we can take advantage of, we will launch it. But right now it's wait and watch. This is not something we want to jump in and have a first mover advantage. I mean, it's okay. We can learn from people's mistakes as such and then launch what's required. On the hybrid funds, you just mentioned that FlexiCap is a aggressive hybrid now. So in a sense, we've got 3 out of the 6 funds as hybrid. So I don't think we are going to, again, there's nothing in the hybrid space that we want to launch. I mean, honestly, the amount of launches you've asked me, I mean, we just launched one large cap fund and we got like enough brickbats for, okay, why are you doing this? So, I mean, if I say we're launching any more funds, I don't know, we'll probably get like tomatoes right now thrown at us. So, yeah, there's no plans for any other funds, you know, it's just the large cap where we thought we could make a differentiation there. SIF is a wait and watch for us right now.
Next question for Ronak. There are certain scripts like M&M and Airtel where we were quite late in adding them to our portfolio. What is the reason for that? And how are you making sure that in future we are early to capture them?
It's not always. it's not always beneficial to catch something early because you may not know how the future may turn out. So we have the benefit of hindsight today to look at these companies and how big they have become and what cash flows they generate. And we can see that we were too late to capture that in the initial stage. So again, the way FlexiCap Fund invests in companies, the way our equity allocation happens, is not just to capture companies who have the optionality of doing well, but we need a good track record in the past. So both companies, M&M and Airtel, I would take one by one. So M&M has had a history of a conglomerate having different segments, but driven predominantly by tractors and automotive. And they have also had subsidiaries in other services, businesses that they built in. Over a period of time, the capital allocation in that group was not at par in terms of the other competitors in each of the categories. They were doing well in pockets, but not as a group because they are part of so many businesses. At the same time, when the new CEO came, a lot of new announcements were made. And luckily, the execution of the management team also was quite good. So that actually showed the last 5 years of results that the company has generated and done very well. So of course, when you see a trajectory of good businesses within the umbrella of the holding company and they do well individually as well, you get a promising way of looking at the future of that business. And now the question is whether you want to participate at a current valuation or not. The valuation was not too egregious in terms of what the value captures within the listed and the unlisted subsidiaries of M&M. So that is about M&M. But with Airtel, if you see, it's a pure survivor story. I would urge investors, if they have the time, to read a book called Telecom Wars, which came very recently, which talks about the gruesome battle in the telecom space and how a few companies have now survived. So consolidation is actually useful for the incumbent players if they're able to push a price increase of their products, which is not very easy in telecom. Yet at the same time, the product or the service that they provide is indispensable for us. And we would not mind a little bit extra to be paid if we have to use that service. So over a period of time, if you see inflation of the country versus inflation of telecom services, that is not caught up. So Airtel definitely has a long way to go in terms of earning money from that. And plus the existing investments that they have made to upgrade the network to 5G, and all of that gives them the advantage of launching other services which customers will want from the telecom provider. Again, the home broadband opportunity in India, although we don't talk about it much, but is growing at a much faster pace from both the leading telecom players in the country. And that is another optionality for this business, which does not require significant capex for scaling that business. It needs capex, but not as much from the overall cash flow of that business. Again, in the past, they've had misfires in terms of their global investments in Africa and other countries. They have rationalized some of them and they have made sure that they are stronger in those markets. If not, they are number 5, they're at least number 3, number 2 in many markets. So I think a lot of these things have worked for them in the past. Again, the question came whether what is the right valuation to pay for a business like that. When we felt it was reasonable, we thought that the company has a good execution history and a potential to keep doing that in the future. Makes sense to buy it at that price.
So also, a lot of times these questions get asked, assuming that the stock price is the only variable that matters. People don't look at the underlying business. Now, buying a telecom company when the price wars were still going on and there was no certainty as to whether there will be 2 players or 3 players. So this company, Airtel, also has the tower business, and if the third player had gone bankrupt, a lot of receivables would not have come in. A lot of uncertainty was there. Or in the case of Mahindra, one of the debates that we keep having internally, and we had even in the past, was what is the impact of the entry of Chinese players in the Indian auto market. Now, some clarity was there that they will not be given a free run to just take over the industry, and then the product launches happened from M&M. As Ronak mentioned, a lot of clarity came on capital allocation. So, yeah, 2 answers. One is, if one says, why did you not buy it lower and you are buying it now, then it means that every company should just be bought when it's listed, and you can never buy it after that ever, because if the company is well run, the stock price will keep going up over time. So that is one answer. And second is that the business does not matter. You should have foresight into what the reported numbers will come, what the business developments will happen, and you cannot change your mind ever. If you have not bought it lower, you cannot buy it later on.
Superhuman intelligence. That's the assumption in the second part of it. Okay. Next question for Raj. E-voting for resolutions of companies you own in FlexiCap, why approve ESOP allocation to ITC shareholders when there has been no significant reward to shareholders over the past 5 to 10 years? Is there any merit in diluting our existing shares via ESOP?
Yeah, so a return to shareholders is in no way correlated to business returns or the business performance. So when we are voting on resolutions, there are multiple factors that we take into account. So for example, just in this case, when we are voting for a ESOP policy, we look at what is the total dilution that is going to happen, what is the per employee limit that is going to happen, what is the exercise price, etc. All the factors are taken into account, and based on which we vote either for or against the resolution. Also, we have proxy advisors on board who give us recommendations on what to vote for. So we take their recommendation also into account, and based on that, we take a call. So one is business performance, and other is shareholder reward. So I don't think in any way they are correlated.
So this is always a tricky part, right? What is a fair managerial compensation? Now, something way over the top got approved in Tesla for Elon Musk. Is that justified? Not justified? Now, some people say if he creates that much value, why not give him a portion of that? So while we would want all our company managers to work for free for us and give us that extra profit after tax, the employees also want to be paid fairly. If people are working for a long term, and ESOPs especially have this thing that they tend to keep back the people because the vesting periods are extended. Otherwise, the employee churn tends to be a bit higher. So there are mixed feelings around this in a way.
Just to add one point, there are some companies in the portfolio where the CEOs or founders take only $1 as salary by providing a lot of value to the business. So there's a balance. It's just light weight.
Next question for Rajiv. As a risk management strategy, can you use long-term index put options on a major index to hedge the portfolio against systemic risk and limit portfolio losses?
It is permissible, but the liquidity is very, very poor. So in the past, we have actually held index long-term call options. So to the extent we were having cash and we were not deploying, some call options were available very, very cheaply. So we said we can just buy that. If for some reason the market runs away, we anyway have participation. But if market is flat or does not go anywhere, the price on the call option was so less that it was just barely covering the interest cost of that 2-year, 3-year period. So we would make that up in money market or something like that. So it was very, very cheap as such. We can do some of these things, but doing it on a sustained basis, thinking that something bad will happen, you would give up a lot of your portfolio return because these don't come cheap most of the times. And liquidity is very, very poor. So for the 3-year kind of options, bid offers are very, very wide and hardly any volume gets traded.
Next on private banks. Private banks slowed their growth rates from 20% book value compounding to 15% now. Valuation derating has already happened as they trade between 2.5 to 3 times price to book. Given balance sheet of PSU banks is also improving, do you think these private banks will continue to maintain their premium over PSUs, or will there be a downgrade on multiples?
Multiple upgrade, downgrade anyway depends on sentiment. So I think given that the multiples have come off, I don't think there's a lot of room for them to come down even further. PSU banks, there has been a lot of cleanup which has happened not only in terms of the balance sheet quality, but even operationally with the mergers. Now a few banks have nationwide networks, product ranges are improving, and there is this talk of one more round of bank mergers to have banks which are globally in the top 100 kind of things. So some of them can operationally improve. State Bank has been one a bank which has been at the forefront in terms of having a complete product range and scale and all of that. A couple of more may come in that space. So we are watching it. As of now, from the consumer perspective, I think still the preference of a person who's out there to open a first bank account, I think some preference would lean towards the private sector banks.
Your current view on an exchange business like NSE or BSE, they are toll road businesses with a long runway of growth. They will trade at premium valuation. Will you consider investing in the NSE IPO when it comes?
So we have owned things like MCX, we have owned things like IEX, CDSL. NSE would, at the right valuation, would be a good addition to the portfolio, but I don't think at IPO it may be available at an attractive valuation. Also, one should keep in mind the cyclicality of this business. So a lot of the profits of NSE, BSE have come because of exploding near-term option contracts, and there could be some cyclical downturn in that space. So we will watch this, but these are the kind of businesses we would like to own someday.
Okay, final one before we open up to the...
I just want to plug one of our research colleagues has made a recent presentation on NSE and exchanges as a business. Maybe interested investors can definitely learn more about that business.
All right, so final one before we open up to the audience, so please be ready with your questions. The final one is from a wealth protection and income standpoint, would you rather hold US Treasury bonds than Indian government bonds or T-bills?
Can you please repeat, sorry?
The question is from a wealth protection and income standpoint, would you rather hold US Treasury bonds than Indian government bonds and T-bills?
So if you're holding US Treasuries, you have predominantly running two risks. One is currency as well as the US. So if your target holding is the utilization of fund is in US, then you can probably think of it. But there are a lot of global changes happening in terms of political, in terms of fiscal. At this point of time, looking at the both US fiscal issues or global developed market fiscal issues and Indian government fiscal condition, I would suggest stick to Indian government bonds. There's a lot of work which is happening from government in terms of fiscal discipline. Although you may get that additional benefit from rupee depreciation over a period of time, but in terms of clarity about government's fiscal path, the India is right now in a really sweet spot. I would suggest stick to Indian government bonds. Yeah.
All right, thank you very much. We can open up.
Yes, please.
Hi, thank you everyone. Always a pleasure. I think this is my third or fourth year, and this year I really see like a big change in all of the things that are being launched. So congratulations. I think it's a lot of years of all of the effort. So congratulations to the team there. One question related to that is, because of all of these new initiatives, is there risk of the team's time and energy being diverted to these things and a shift from your initial main objective?
Some of these, am I audible? Yeah. Some of these things will have separate teams. So there'll be separate entities. So our Gift City team is already there. We have like a 5 or 6 member team, which is already sitting out of Gift City in Gandhinagar, and they are managing that part of it, you know. So one thing that's common across our organization will be the research process, in the sense that research will be common across all the divisions, but it'll be managed by separate teams. So we don't see that as too much of a challenge going forward.
Okay. And one question specifically to the FlexiCap fund. Now, I think I remember in the past you had mentioned on an average, the holding period is about 2 years of an investor in the FlexiCap fund. Are actual longer term investors, let's say 5 years, 7 years, who do have that capability, are they at any disadvantage because of this low average holding period of other investors in terms of decisions you may have to take at a management level?
So there's a bit of nuance for that. So the report comes to us from CAMS on a weekly basis. On a monthly basis. There are other weekly reports, but this data point comes in the monthly report. So it has two parameters. One is the average period of a redeeming investor, and the second number is the average holding in number of days for our equity assets. So for example, if Raj invests and sells after 2 years and 1 day, his redemption will be reported as 2 years of holding for a redeeming investor. If I have invested for 5 years and I have done nothing, then my report will go in terms of days of closing assets. Now also this days of closing asset is colored by another thing. If I have held my units for 5 years and Neil has come in the last 1 year and he has neither bought more or nor sold, so the days in closing assets will be weighted average of 2 of us. So don't read too much into this. Our behavior is for investors who are invested minimum for 5 years. We don't take into account the investors who are coming in for 1 year or 2 years. Exit load anyway is there to discourage that kind of churn. Our redemption period is longer than the industry average and our closing assets are also longer. So people who invest with us, typically most of them stay for the longest period, but there are some people who churn out in 2 odd years.
Okay, so from your management style point of view, you don't solve for a 2-year
Yes.
investor. Okay, thank you.
Thanks.
Request everyone to keep your questions to 2, and if you have any more questions, you can come back in the queue.
Hi.
Good evening, sir.
At the back, just one.
Sorry, me? Yeah. Hi. Thanks for this AGM. It's been quite helpful. First question is on global investing. How would you sort of recommend investors to think about it from a percentage allocation standpoint? And Neil did briefly touch upon the global PMS fund that you have. Could you throw some more light on that and how can investors think about it?
So as Neil mentioned, we'll have a separate webinar for Gift City. So whoever is interested, we will put out the registration form link on social media and email probably. So people can sign up for that and separately do it. India's market capitalization in global market cap is mid-single digits kind of thing. So a lot of opportunity set is outside of India. Some of the newer listings in India, their parent or even the older listings, the parent companies trade at far lower multiples. So whether you look at Maruti in India versus Suzuki abroad or Hyundai in India versus Hyundai in South Korea or LG, many of the parent companies are available at far cheaper valuation levels. Some of the opportunities are not present in India. So innovator pharma companies in the GLP space, for example. Of course, generic companies are here, but the innovators are outside of India, or some of the large battery companies or EV companies are outside of India. So depending on one's individual circumstances, one could look at least to begin with, maybe 10, 15, 20% kind of equity allocation to overseas stocks. But it's largely an individual decision end of the day.
Got it. And second question was on any books you'd recommend on financial statement analysis. I think investment, there is still fair bit of literature, but more in-depth sort of balance sheet analysis, cash flow.
Plenty of them are there. So if you want intersection of investing and finance, there's a book, Accounting for Value.
Sure. Thank you.
So while you talked about Power Grid Corporation,
also interested to know if what is your take on the InvIT structure, the PG InvIT, and we hold REITs in a few funds, but as we mentioned, we want to keep cash for the time being while we deploy it in REITs. Are we also open to InvITs?
Sure. So InvITs are of a few kind. So one, of course, you mentioned the PG InvIT or the power InvITs. So PG InvIT is there, or IndiGrid Investment Trust is there. Then there are a few InvITs with road assets that are there. InvITs are slightly more complex instruments as compared to REITs. Initial reported yield may look very, very attractive. So if you just take the last 12-month payout in terms of rupees per unit and divide by the traded price, some of these will look like double-digit return products. So you may see returns of 10%, 11%, 12%, and people may get attracted to such returns. However, what you should know is that these are finite period contracts that are packaged in InvITs. And in many cases, the revenue could be capped and the expenses may creep up over time. So specifically in the grid assets, for example, the revenue gets capped and operation and maintenance expenses may go up over time. So what is the yield right now may not sustain over the longer term. So PG InvIT itself, I believe the management has guided for a lower payout in the future years as compared to what it is. In road assets, typically there may not be any terminal value if there's a build, operate, transfer kind of contract. So at the end of the contract period, you hand over the road asset free to the NHA or to the government. So these are more complex. We have looked at a few of them in the past, but given that so far there has been only a 10% available limit, and most of the limit in something like a conservative hybrid fund we have used in REITs, we have not looked at InvITs too seriously. Maybe we will consider them down the road if something interesting comes our way. Thanks.
The second part was if you can discuss the reason for exiting ITC hotels completely, if that is possible.
So ITC hotels is something which was not the reason to buy ITC. So the reason to buy ITC was their core cigarette business plus their new FMCG business and a few other activities. And ITC hotels traded at an attractive valuation for exit. So hotels, as you know, as a sector, has seen a huge upswing in the post-COVID travel boom. And end of the day, it's a capital-intensive business. Of course, most people are trying to get into the asset-light kind of model as well. But that was not something that we were excited to hold on for the longer run. The analysts in our team took a look at the business independently, and we felt that the valuations were ripe and we should exit.
Thank you.
Thank you. Yes, please.
Good evening, sir. I'm Arun Kumar from Chennai. Glad to attend this first meeting in person.
Thank you.
My question, as a retail investor, if I have taken care of my short-term goals through emergency funds and term insurance, life insurance, etc., or health insurance, and all my goals over the next 3 to 5 years, for the long term, does it make sense for a retail investor like me not to look at asset allocation and rebalancing and to be completely invested in equity?
So one, when we talk about equity, look at global diversification as well, because I had that slide. Sometimes as long as 11 years, you may see a market doing nothing. So sometimes the cycles can be long, and if you can achieve meaningful geographical diversification, that will always be helpful. Also, take a look at some of the mezzanine assets. So something in between equity and fixed income, something like REITs, InvITs should be a good diversifier. But otherwise, broadly, your thinking is correct. If your short and medium term requirements are well taken care of, then largely you should be in inflation protected assets, growth assets.
Understood. Sir, but if I am invested in funds like Parak Flexi Cap Fund, which take care of the asset allocation rebalancing, then in that case, I would not have a need to diversify on my own?
So we may not be in FlexiCap be able to offer global diversification, that the end clients will need to do it themselves. So right now we are at 11%, but yeah, there's a limit to how much we can invest globally.
Sir, just one more quick question to Neil. How do you create this culture where you mentioned in some of the podcasts that you don't have a target in terms of AUM or market share, but still how do you create a culture where this team has been growing the business immensely? How do you balance the growth and the performance of the team?
So I think one thing is a lot of us have been together now for a very long time, so we know each other. There are shared values. I think that's important to have shared values in terms of your core, what you want to do. And we're not, we're not chasing things. I think all of us, we don't want to just keep chasing. We want to actually do what's right for the end investor. And if that's your ultimate goal is to try to do what's right for the end investor, then all of these things kind of just come together, And even, I think that attracts also people that we keep hiring. And sometimes people don't like our culture. Let's be very, everyone doesn't like the culture.
Right.
There are some people who want targets or who want something more exciting or whatever each one's, it's for each one to decide what they want. And those people leave immediately. And whoever likes the culture stays on. I think one thing, I think that not giving targets has really helped to build a very collaborative culture. In the sense that when you don't have internal competition as such and everyone competing amongst themselves, I think what happens is people start helping each other. We've seen that. It's not like something we had thought about that this would happen, but this is the outcome of it, that each department, each individual is helping the other person. And again, what we have told everyone, look, your end of the year bonus, salaries, everything will depend on how well the organization does, So it's like in cricket, if you can hit a century but you don't win the match, then what's the point of the century? So right. Similarly, we need to win the match irrespective of who hits the century, and we all do well with that.
Yeah, thanks a lot.
Hi, thanks for the opportunity. I have a questions on a valuation, like what role does margin of safety play in our buying decision, and how do we avoid value trap in valuation which appears superficially attractive?
So Graham and Buffett and all kept saying margin of safety are the three most important words. I think we live in a world where no margins get the best valuations. So we are in a different time right now, but we are still old school. We still want protection against things going wrong, where if we buy something, then even if some of the things don't go as per our expectation, we don't lose too much. So it's key to the process that we undertake. That's primarily the reason why we are not in a hurry to deploy, and periodically you see some amount of cash. Value trap. So many a times you buy something which you think is at a discount to intrinsic value. Time goes by where instead of the market price moving up to intrinsic value, the intrinsic value starts eroding and falls below the buying price. So I would look at those kind of companies as value traps. So we keep evaluating things for bad capital allocation decision, changes in management quality, or technological obsolescence, or changing business dynamics. Hopefully we don't get too many of them, but once in a while it would be inevitable. So investing is a probabilistic kind of endeavor. Out of 10 stocks that you buy, maybe 5, 6 do reasonably good, 2 or 3 do moderately okay, and 1 or 2 may actually turn out to be bad. So one has to try and keep minimizing it, but you cannot fully avoid it because the world keeps changing. Now, if you are in an exporting company and suddenly 50% tariffs come on your product, this comes from nowhere. Or if you are in the hospitality business and COVID hits, again, you can't do anything. If you are a photo filmmaker and digital cameras take off, and again, your stock goes down. Is something a value trap or not? A lot of things are fuzzy, so some people would call something like coal assets, Coal India, a value trap. Looks cheap on price earning, good dividend yield, but people would say there's not much of terminal value. So one has to have some judgment and keep re-evaluating. So one trap that people make is people classify it as deep value or as a value trap, and then they stick with it. They don't change their label. Here, what you have to do is form your opinion, but as and when new data comes in, keep re-evaluating your opinion over time. That's the best defense against value traps.
Thanks. Hi. I have two questions, one on a portfolio stock and one on the broader construct. So if I look at the India portfolio, there are around 27 stocks, which is around 66% of our portfolio. 11 of these stocks are less than 1%. And there are, I think, 3 odd REITs, which are another 0.6, 0.7%. So my question is, do these tail positions make a lot of sense? Obviously, you are a value investor and you always maintain starting valuations matter. Because some of these, allocations are 0.02, 0.03% also. So is it, the right way to look at adding more tail positions from here on, or, adding some of these stocks where maybe 6-7% liquid return nuance, but some of these stocks could give you higher returns, 10-15%. So add to some of these tail positions, or maybe adding some more tail positions given the size of the fund is 1.25 trillion rupees. So what's the thought there over a period of time? How do you look at the portfolio? Even some of the sectors which are off flavor or large caps are still smaller allocations. So some thoughts on the portfolio will help.
Yeah. So sometimes it happens that we buy something and the price moves because of whatever reason. So some brokerage comes out with a buy report or some other large investor starts buying. So one option is we have bought a small quantity, just go and dump it. Other option is let it remain. Price may come again in your buying zone where you can buy more, or anyway the analyst is covering the stock. Sometimes what happens is a small allocation forces you to track performance closely. If it's not in the portfolio at all, even if it's something that you have done a lot of work in terms of assessing business quality, management quality, over a period of time, that company may start getting forgotten because the analyst will say, oh, it's not in the portfolio. I can send the quarterly update maybe after 15 days, or sometimes that urgency may not be there. Even if it's in the portfolio at a small allocation, the tracking intensity tends to increase. So I'm not too worried. So let me flip your question completely. You are saying it's a small position, it will not add meaningfully to your return. Why do you hold it?
Right.
My flip question to you is, it's a very small position. Whether it does well or does not do well, you will not be affected. So why do you worry about it?
The point, Rajiv, is, if you can earn 10-15%, it's better than 6-7%. In case there is a merit, because not every stock would have gone.
So we have cash, 10-15% earning possibility. If that is there, we will anyway buy that stock. We will not miss anything.
And secondly, on a specific stock, Power Grid, obviously you mentioned some of the changes which are happening in the sector. So last 3 years, earnings have grown at 3%. This year, they are flat to maybe degrowing. It's the number 2 stock in the portfolios. They've obviously done a large capex over the last 2 years, and they're still continuing with the huge capex program. So when does, earnings kick in, or what's the sense you are building? Because, at the end, a number 2 stock in the portfolio, 6% weight, obviously there is a dividend yield, but earnings have to come in after a period of time or across cycles. So any thoughts on that will help.
Sure. So this company gets paid for keeping the assets up and running. unlike toll roads, let us compare the grid assets to a toll road asset. A toll road company gets paid each time a vehicle uses that road and passes the toll gate. Here, the grid company just has to create the grid assets and keep the grid up and running, available for someone to transmit electricity. Whether actual electricity is transmitted or not, they get their payment. Now, the date when their payment starts is when the grid gets commissioned. So they don't get paid for the work in progress as most businesses. So a lot of times the capital expenditure would lie on the balance sheet, but it would not start earning. So there is a certain element of lumpiness in the business, but I wouldn't worry too much about the earnings trajectory month to month or sometimes even on an annual basis. Growth will come. I don't see that as a challenge. In response to a previous question, there have been challenges around right of way and those kind of things. Those will get resolved.
Sure. Understood. Thank you.
Hi team. Good evening.
Hey.
I kind of missed the memes on the presentation that we used to do a few years ago. So I just want to ask one question. Every time you buy a stock, there is a logic why you should be buying, when you should be buying. I'm pretty sure when are you selling a stock also, there is a logic behind it. So like we saw in a recent interviews about Motilal Oswal, you used to talk that when you bought the stock, why are you selling the stock? And most of the stocks are cyclical in nature. But when you look at the portfolio, there are certain stocks that seem very expensive at some point of time, at least to me. Like maybe ITC or IEX. At some periods of time, they have looked expensive. So have you not considered selling them off when they looked very expensive? So what is your selling logic? That is what I want.
Sir, if you find ITC expensive in the last 3-4 years,
I'm just asking.
I think you and I both should migrate away from India and go to some other country and invest. It's in a market where everyone wants to be your 10-minute grocery delivery person. They are raising tens of thousands of crores regularly, not earning any meaningful profit, where big box retailers or fashion retailing chains are available at 100 times earnings and more, where the traditional FMCG companies in soaps, toothpaste and all are available at 55, 60 times earnings. This is around 25 times earnings, where you have characteristics of a startup as well, if you want to spin a narrative. They have a mature cigarette business and they have a 15, 20-year-old startup business where they have incubated all the new businesses which make biscuits, which make chocolates. They are the largest atta company. They have done acquisitions of ready-to-eat meals and various other products are there which are arguably not at their full earning potential. So, yeah, you are even more fundamentalist and hardcore than I am in terms of valuations. I never expected this.
Thanks.
Thank you for your presentation. I hope I'm audible. I just wanted to know about your views on the circular financing that is going on in the US tech industry right now.
I have zero understanding of that. Ronak, you can explain. He takes the tough questions. He's the high IQ person in our company.
Thank you, Rajiv. So, although the attention disproportionately is given to the circular financing, one needs to understand what people are actually buying. So, just because a company which is selling a product buys equity stake into another company does not mean that it is the whole and sole cash flow generation for that business. Here, I would say a small portion of the market today is being funded by some of the equipment makers. I'm not mentioning names deliberately because there's too much confusing narrative around these companies. But if you're funding them, it's not necessarily mean that this is the only source of revenue or cash flow for that business. One has to also evaluate that this business can go away if the underlying company being invested in does not generate cash flow for that particular product that they're selling. So over a period of time, we have to just zoom out and see where the money is going, how the money is being deployed, is there actual cash flow generation happening in some of the companies happening within that ecosystem. So right now, we are not seeing that. We are only seeing the part where the circular deals are being announced. That is one. So Rajiv's understanding is actually correct. There's nothing to understand there. It was very hard to figure out what is going on with different private deals happening in companies, how they are raising money to stay alive when they are trying to build out over here. What we are trying to focus on is the cash flows that are obvious from the companies that we can study, and can these numbers be understood. So there are cloud computing players who are generating their own cash and reinvesting that money to make AI data centers. There are digital advertising companies using that cash flow to generate AI data centers, or maybe trying to improve their own product recommendation engines for selling advertisements. So those numbers are far better to look at than the headlines of some of the circular financing deals. So it's very hard to conjure up a narrative every time something like this is announced.
Yeah. Just wanted to get your views on portfolio construction. So for somebody in their, let's say, mid-30s, early 40s, planning for retirement, how do different instruments, liquid, arbitrage, flexi, and of course, like, should there be even DEF in meaningfully allocated in the construction of the portfolio? Assume they have reasonable risk tolerance.
Sir, my recommendation would be either consult someone, or there are very simple books like Let's Talk Money or some of the other financial planning books. Very difficult to answer in one line. So one can give general principles, but each individual circumstances would differ. So in the West, people say, oh, 100 minus your age should be your equity allocation. But that, to my mind, doesn't really apply in the Indian context. If you are planning on consuming all your money in your lifetime, then maybe it makes sense. A lot of people look at it in generational terms. So I would say seek out a certified financial planner or some investment advisor, consult for half a day, one day, explain all your circumstances and arrive at a proper plan. General principles are well known. Have proper medical insurance, have proper term insurance, have emergency corpus, whatever you need in 3 months, 6 months, put in liquid arbitrage, 3-year kind of, 5-year kind of money, hybrids, or 5+ year money in equities, have some global diversification. Look at the content put out by Neil Borate on fine print earlier in the Mint newspaper. So there's ample content out there, and as Neil Borate was saying, YouTube is the largest financial advisor in the country. Maybe you'll find a lot of content there.
Yeah, no, I'm a subscriber to Neil Borate's WhatsApp channels and the newsletters as well.
You are well said then, sir. There's nothing more that I can add.
Maybe one more thing, can be considered as a question. This is for Neil. So Neil, my name is Mohit Parikh, and I'm yet to check the family tree, but if we turn out to be distant relatives, like, can I claim some ESOPs?
Sir, let me answer on his behalf. Promoter families are legally barred from getting ESOPs. So you've just, even if you take employment with PPFAS, we'll make sure that family tree is checked and you are excluded from the ESOP pool. He himself does not get any ESOPs.
So I'm the lowest paid employee at PPFAS. Maybe I should give myself a big fat bonus at the end of the year.
Thank you for clarification. Yeah.
Hello, good evening. This is my first time attending this forum, and thank you so much for this opportunity. My first question is related to the Japanese bond yield spiking up a bit. There's a lot been written on this recently, and all kind of financial influencers are, saying that this might trigger a global sell-off because they are so heavily invested in the world. What is your take on the same happening?
Let me ask a resident bond expert who's just gotten beaten up by his daughter today on his views on Japanese yields.
So, as I said previously, see, the problem with developed nations right now are predominantly from fiscal point of view. A lot of these developed nations have increased their fiscal deficit, and to the certain extent now it's affecting to their inflation also. Sustainable long-term higher inflation. Japanese yields we've not seen in last 20 years above 1% levels. So globally also now the reallocation of capital is happening, and I'm sure it will happen from Japan. It will probably start from Japan, because as you rightly said that a lot of Japanese institutions, the carry trade predominantly which was placed for last 20 years is getting unwind now. Japan institutions will start finding Japan yield itself attractive compared to other nations or other asset classes. How it will unfold, to be very honest, I don't know. When will it unfold, again, I don't know. But over a period of time, the reallocation of capital will definitely happen. I think there was this question about investments in US treasuries or in domestic. You will see for past 2 years, US treasuries are close to above 4%, whereas most of the emerging emergings have done exceptionally well, India being one of the examples, predominantly because most of the emerging nations are focusing on controlling inflation, focusing on fiscal consolidation, which in return affects your bond yields. To answer your question, whether it will create panic, I don't know, to be very honest, but the reallocation will happen. Now, to certain extent, I mean, it's anyone's guess, to be very honest.
So I asked this question because we've seen a lot of FII selling happening in India for the last 12 months or so. And with this thing coming into the picture, do we see more of this continuing from the Indian equities market or maybe even the bond market happening?
So Rajiv can probably answer for the equities, but from bond perspective, see, India from bond perspective becomes expensive because you have currency depreciation, which they have to consider, which is 3% on an average, we've seen for past 20 years. Now you take 10-year bond yield, which is close to 6.5 or 7% for past year, it was close to 7%. You take out 7%, you are close to 3.5% on an average, whereas your US treasury is close to 4.5%. So that's why the debt reallocation is very natural to happen from emerging market to developed market, predominantly because of the carry trade which is now going out. From equity, I think Rajiv can answer. From macro perspective, the outflow is happening predominantly because of the uncertainties, the global trade war and the tariffs, which still we don't have clarity. About valuations, I think Rajiv can answer.
So equities, a lot of moving parts to it. Very difficult to pinpoint. It's almost like the butterfly effect, butterfly flapping its wings and various impacts being felt across. Now, how many people are carry traders who have borrowed in Japanese yen and who have invested in directly in Indian equities? I think the number would be very, very small. I don't think that direct impact will be there. But if there's a retirement fund somewhere who feels that bond yields have gone up meaningfully and they offer attractive opportunity to invest as compared to equity, and in their quarterly rebalance, will they shift money out of equities? Who knows? But again, one of the reasons why specifically for Indian equities, I would not worry too much is that anyway, the FPIs have been big sellers with or without Japanese bond yields. So I don't think they are that big a factor overall. The biggest worry I have is the relentless supply of expensive paper in the equity markets. More than Japanese bond yields, as an equity manager, I am more concerned about the starting valuations and the endless IPO, QIP, block deals by private equity owners, promoter share sales. I am more worried about that.
One last question to Ronak. So, what would you suggest to be some core understandings and some core beliefs that an aspiring research analyst in the field of equity should have to build on going ahead?
I think two important non-negotiables according to me. One is you need to have the competence to understand financial statements, understand different businesses. So a course like a CFA will probably equip you with a lot of tools needed to do the day-to-day work that is required. And second, use those tools with your curiosity to understand different things, understand how the world works. Ultimately, everything is connected, but we need to understand how capital also flows over a period of time. So those connections, those curiosities, that will definitely add on to you becoming a better analyst over a period of time. I think those two are complete non-negotiables. Beyond that, it's up to you how you scale your career. All the best.
Thank you so much.
I found the most undervalued queue and I'm back for the second round of questions. This is a behavior question, and especially as an equity manager, I feel one past example is the Operation Sindoor thing that happened. And when there are such external events beyond any of our control, I think COVID is another good example. As a fund, what rules do you have in place that this is an external event where I will sell? And as an investor, what should I have in place to again help me?
So our mandate is to invest when attractive equity investment opportunities arise to the extent of money available in the fund. Existential things we don't worry about at all. So what happens if India and Pakistan get into an all-out nuclear war, or what happens if an asteroid strikes Earth and wipes out life? We don't have any risk mitigation against those kind of things. The risk mitigations that we have are per stock limits, per sector limits. The allocation that you give us is largely for Indian equities. So global diversification is to be managed at your end. Diversification between equity, real estate, bonds, gold, whatever, that is the end client's responsibility. So we don't worry largely about things that are not in our control.
So my second question would just be a follow-up on that to understand it better. What would then lead you to sell if there are these kinds of events?
What leads us to sell is either the management that we trusted turned out to be not trustworthy, or the business changes for the worse, or the valuations completely go haywire. So some combination of these.
Thank you.
Thanks.
Hi sir, my name is Kashyap Jadhav. Recently I have visited Morningstar Investment Conference. There was thoughts given of mutual funds investing in public companies and private companies. So what's your takeaway on that?
Mutual funds are not allowed to invest in private companies, sir. So we only invest in public companies.
Sir, if in future, what's your
one is it's extremely unlikely to be allowed because mutual funds are open-end products. So we have to offer you a daily NAV. So very, very unlikely that it will be allowed. And we have no plans on private companies under the mutual fund structure. So as an organization, we may have a separate set of people doing private equity or whatever. That depends on the organization's plans. But under the mutual fund structure, very, very unlikely.
So my second question is, what was your rationale behind buying Zydus?
It's a company that we have owned in the past. They dominate the some of the categories that they are in terms of the artificial sweetener or some of the table spreads and those kind of things. And they acquired the huge Heinz portfolio that was there. And essentially the stock price had been flat for a very long time, and there was a strategic investor who was looking to sell. So in the last 4-5 years since we sold, the price was essentially flat, whereas the underlying business had seen a lot of improvements. So we saw it as a good opportunity to re-enter the company.
We'll take last 3 questions, one from each queue.
Okay. Hi sir, my name is Sarana from Chennai. Actually, my question is from Mr. Rukun's presentation. In that, he said in arbitrage, around HDFC Bank's valuation is 59,000 and HDFC Bank's valuation is 62,000, right? If something happens at the rate of merger, that value of HDFC Bank is reduced to 50,000 or something, how you are manage the loss actually in arbitrage fund?
So, you are anyways going to get, the idea is if you are going to buy HDFC Bank,
yeah.
Let's say you've decided that I want to buy HDFC Bank,
okay.
Then how do I buy it? What is the better way to buy it? Should I buy HDFC Limited or I buy HDFC Bank in that example?
Actually, my
so,
question,
so the value decreasing in HDFC Bank would have impacted you in both cases. It's just that with HDFC Limited, you bought it a bit cheaper.
Yeah, I am asking this from arbitrage point of view, that the same thing happened in IDFC too, right? After IDFC merger happened, if you are thinking is the arbitrage or is the value buy?
So in case of the large cap fund, it is not an arbitrage from the perspective that you buy the stock and you short the other firm. It is simply that between the two, which one do you buy to get that same exposure cheaper?
Okay, another one more question. If you are getting a 1 year bonuses upfront, will you invest all the amount in PPFAS FlexiCap fund or will you choose another fund or other way of investment? Raj or Neil, anyone? For lump sum investment.
Yeah. So again, I think we all will have different answers to this because we all are in different age groups or different goals in life, and some of us have young kids, some older kids, whatever, so each one of us will have a very different answer. Mine would be, yes, I would be at least 75 to 80% invested in FlexiCap, the rest 20% in something probably a bit safer. Yeah, and if I might have some asset purchase down the line, I think in a couple of years. So maybe if that is also happening or something, then at least most of it in probably safer store. So it depends on what my situation is at that time. But as of right now, probably 75-80 in Flexi and the rest in, say, DAF or the large cap fund that Rukun is going to have.
Marketing point of view. Thank you.
Good evening. So I have a question for Ronak specifically regarding Narayana Hridayalaya. So I understand that the company is good and we have been invested in Narayana Hridayalaya for a year now. So I'm asking this question as an individual investment into Narayana Hridayalaya. So I haven't seen increase in number of shares invested since January this year. Does this mean that the value that you have anticipated is like we are done there, or do you see more value there? Because the last Q2 statement that has come in, we are seeing revenue coming in from Cayman Islands assets, and plus the UK is still unexplored for them. So if I approach this organization, I approach it as a multinational organization that would be getting value from multiple places, not just the hospitals, because insurance again is something that's underappreciated in this organization. So do you think there is more value there, or because I don't see the fund investing more into this?
There could be more value there, but doesn't mean we have to chase the valuation as the price keeps going up. So there might be a sweet spot where we think the valuation is comfortable to again buy more and add to the portfolio. At the moment, it did not seem like it. I don't want to comment on what we will do in the future with this particular stock or any stock that we own. But definitely we think it's a business which is run well. So we'll see how it grows.
Any insight in sweet spot? When you say sweet spot, what would that
Sir,
be?
future prices I cannot tell you in advance at this price I'll buy, or so like whatever we could discuss in the public forum, we have mentioned that. Beyond the point on an individual stock, we will not be able to exactly tell you how we would think about.
No, I wasn't asking for the price. I'm sorry if I came across that way. I wasn't sure what do you mean by sweet spot. So that's where my question is. My second question is to you, Rajiv. Last year during this presentation, you had recommended Thinking in Bets by Annie Duke as one of the book recommendations for investors. Any recommendations this year?
I don't know whether this. Yeah, The Art of Spending Money was good. Enjoyed reading it. Morgan Housel. Currently, I'm just at the beginning of Andrew Ross Sorkin's 1929. It's not a recommendation. I don't know how it will turn out, but that's what I'm currently reading.
I went through Thinking in Bits. It was really good read. Thank you so much.
Thanks. Whoever is in the queue, if you can come up front, whoever is already there, we'll take those final questions and then we'll wind it up. Yeah. Yes, please, go ahead.
Yeah, so hi, good evening everyone. I wanna ask, can you share an example of your recent exit and what drove you to that decision? Is it valuation only or there are other things as well?
So exits have been largely driven by valuation and concerns around where in the cycle we are. So we exited a few capital market related stocks. So we exited things like UTI Asset Management and Motilal Oswal Finance, largely because this space has seen a big uptick in profits and growth recently, and some of these things could be cyclical. So the investment banking income, IPO, brokerage, the profit sharing fees that or performance fees that one gets in PMS and AIF, all these are somewhat cyclical. So largely it was around valuations.
Great. Okay, so how much importance do you give to PE multiple?
It would depend. It's again very, very difficult to answer in one line. Some companies are to be valued on asset basis. Sometimes the PE ratio can be very distorted if the current year's earnings are not normal. So some things like, let's say, cement plants or shipping companies, etc., you would value on asset basis. Some stable, moderate growth companies you may value on a PE basis. Some companies where there are multiple business line items, let's say one or two business lines are currently in losses, whereas some other business segment is very, very profitable. You may do sum of parts. So it would depend on different companies and different sectors.
Okay, thanks. That's all from my side.
Hi, good evening. I'm Anil here. I'm asking this question on behalf of Rahul Gala. Good evening. I myself, Rahul Gala, and I attended today for the second time as the unit holder as well as MFD. First of all, I thank you for giving the opportunity to all the unit holders to interact with you and with your team to keep faith and transparency among them. And I find this meeting more valuable and learned a lot from you all. Also, last year, I am using my iPhone to translate all your speeches to text so that I can understand. Although it's not 100% accurate, but I still manage it. And I am asking whether you can provide accessible to your community where you can share your thought with them next time here in unit holder meetings. More of our community will be encouraged to opportunity to attend, learn and interact. I believe your philosophy and though will inspire them to be a value investor in some or the other way. What is your through on this?
So yeah, I do remember it from last year, and you had asked for again the translation, and we did actually. My team, Shailendra from my team, we did try to figure out if we could do this year. Unfortunately, nothing was working out. Wasn't. I think the stage is very small, and having somebody to translate was not really working out, and. He's looking at other possibilities. I don't know. I can't give you an exact answer right now because that's another team that's looking into this possibility if we can do something about it. If you have any ideas, you can please write to us. I think you are in touch with Shailendra anyways. Yeah, we've not really figured out how to do this, and we are figuring. We are looking at different things to do, but nothing concrete so far.
Yes, please.
Just a minute, he's typing something. Yes. So thank you for your response. And I can understand that you could not figure out, but next time we can work together to figure something out.
Definitely, definitely.
Sure. So one via media definitely is the questions that people have, apart from in-person questions, the form is put out well in advance. So you can put your questions well in advance. And some of the accessibility features, even if they are not available in live streaming, the post the live stream, once the recording is out, we can surely figure out some of these things with that.
Yeah, we can put a transcript then. Transcript would be probably a better way, but that'll be a little delayed.
Yes, you're correct, but sign language is the most suitable for them to understand as well.
We'll look at it for next year.
Hi, good evening. Had a great time. It was my first session. Really enjoyed it. Sorry. Okay, so my question is around the large cap fund. See, anytime there's a new fund, there are competitors quick to come in with the same product. And this is a small universe of 100 stocks. So do you think with that happening, just want to understand how you think about the competitive play? Like, is the alpha going to go down, the arbitrage opportunities, are they going to diminish with competitors coming in?
So if I only talk about the mutual fund space, the competition would be limited because this is an active fund in the large cap category. Most fund houses already have an active fund in that category who already have a certain strategy. So, I don't expect them to completely transform their strategy because of us. So I believe the competition, at least from a mutual fund space, would be limited. Other than that, there are people already trying to exploit a lot of these. So, there are already people trying to exploit index arbitrage or index rebalances and so on, which will continue. So, that anyways has been there.
And that doesn't take away from this being the differentiator for this fund, right? Like a little alpha that we can expect, that will play out over the long term.
Look at it that like from a purely passive funds perspective, who is only transacting on the rebalancing date, you get to do it better. Now, that spread might come down over a period of time because of competition, we don't know. But it's still better than doing it on a single date when every other index fund is doing it.
That does make sense. Thank you.
Hi, good evening. Last year, you had mentioned that you had missed out on BSC, not buying BSC. Are there any particular stocks which you feel this year you could have added in your portfolio and you missed out? The second part is in 2023, I remember you, Rajiv, not being too excited about the real estate sector. Has anything changed in the last 2 years? How do you see the sector, and would you be willing to invest in any real estate stock in the future? Thanks.
We own a small position in Nesco, which is in a way real estate, or we own REITs, which are there. Last 1 year, plenty of stocks where the stock price went up and we did not buy, but no regrets because some of those things did not make sense at the prices at which they were and at the prices at which they are right now. Overall, market has been sideways. Okay, where we are.
In real estate, my specific question was with the specific companies that do projects in terms of residential and others. So has any view changed in the past 2 years?
Given the pace at which private equity players, founders are getting exits in the listed market, I think luxury real estate should do really well, but not planning on buying any developers.
Okay, thank you.
Some companies which later on turned out to be fraudulent also had some fancy Gurgaon properties, I believe. Thank you so much.
Thank you, everyone. Thank you for staying all the way here, and really appreciate you all making time out, and thank you for investing with us. Thank you.